students, a very good morning. I'm Swetha here. I will be helping you out with financial management for the next 2 days, wherein you can cover all the concepts of financial management. And what we will be mainly doing is we will be covering the important questions from ICSI material. Important questions in the sense, the questions which need some, detailing, the questions which need certain explanations. Then past exam questions. Okay, so these two is going to be our focus. And before that, we will have conceptual clarity. That is the main thing I'm looking forward to. It is not about how many problems we solved, it is about how well we have solved these many problems. Okay, you've done 5 or 6 problems, whatever the case may be. How much is the conceptual clarity that you got? How can you remember the formulas even without by hearting them? So, this is going to be the basics. All right. So stay with me till the end with the same energy level. Let's crack it. Okay. So now, before starting every topic, I'll just give you a checklist. What is the meaning of checklist? What and all are the things that you should go through before going to the exam? Say, for example, if I say capital budgeting chapter, then this is the checklist. Payback period when cash flows are same every year. Payback period when cash flows are unequal. Discounted payback period. Accounting rate of return or average rate of return. Then certainty of cash flows or probability. Standard deviation, covariation, risk adjusted rate, net present value, IRR, profitability index, capital rationing, joint probability. So if you are able to recall the concepts of all these 8, then you are done. So the day before the exam, just stick, I know this, I know this, I know this. Okay. So try to do a small problem from each one of them. Then conceptually, you're done with it. Okay. And for theory, obviously, you'll go through the PDF that I have already shared. Okay. So now we will start with the first one, that is going to be, and in today's class, I'll be covering these 3 topics, that is capital budgeting, cost of capital, and capital structure. Okay. So now, once again, I'm saying capital budgeting, cost of capital, capital structure. So I'll start with capital budgeting. In the past exam, we have seen multiple questions, especially in June, with capital budgeting. So that is why I'm starting with this chapter. Okay. So now, first one, the first checklist is payback period when cash flows are the same every year. Let us see how to do this. Okay. Payback period when cash flows are same every year. So now, I have said cash flows. I didn't use the word payback. I didn't use the word profit. What is the meaning of cash flow? The actual cash inflow minus the actual cash outflow, the net cash flows, we are talking about that. Okay. And why we are talking about cash flows? Because we are in the topic called capital budgeting. That is how to make use of our capital. Whether I should, buy machinery A or machinery B, whether I should invest in project A or project B, or whether I should invest in project A and B. Okay, so either A or B or A and B. Like that, so many questions, decision-making questions come to us. How to take the decisions, which project to choose, which investment to make, when to make, all such things only this capital budgeting is talking about. So this payback period is one method. Same way, ARR is one method, NPV is one method, profitability index is another method. Like that, different methods are there. Okay. Payback period. Ma'am, payback period andre eno? What is this? Payback period means the time taken to earn back ಇನಿಷಿಯಲ್ ಇನ್ವೆಸ್ಟ್ಮೆಂಟ್ ಅಂದ್ರೆ ಇನಿಷಿಯಲ್ ಆಗಿ ಬಿಸ್ನೆಸ್ಗೆ ಎಷ್ಟು ಕ್ಯಾಪಿಟಲ್ ಇನ್ವೆಸ್ಟ್ ಮಾಡಿದೀನಿ, ದಟ್ ಇಸ್ ವಾಟ್ ಇಸ್ ಇನಿಷಿಯಲ್ ಇನ್ವೆಸ್ಟ್ಮೆಂಟ್. ಅಗೇನ್ ಐ ಆಮ್ ಸೇಯಿಂಗ್ ಇನಿಷಿಯಲ್ ಇನ್ವೆಸ್ಟ್ಮೆಂಟ್ ಮೀನ್ಸ್ ಇನಿಷಿಯಲಿ ಟು ಇನ್ವೆಸ್ಟ್ ಇನ್ ದ ಬಿಸ್ನೆಸ್, ಹೌ ಮಚ್ ಕ್ಯಾಪಿಟಲ್ ಐ ಪುಟ್ ಅಂಡ್ ವಾಟ್ ಇಸ್ ದ ಟೈಮ್ ಟೇಕನ್ ಟು ಗೆಟ್ ಇಟ್ ಬ್ಯಾಕ್, ದಟ್ ಇಸ್ ವಾಟ್ ಇಸ್ ಪೇ ಬ್ಯಾಕ್ ಪೀರಿಯಡ್. Okay, now let me give you a simple example. Now, Pooja has invested 3 lakh rupees in her business. It takes, or let me just say, cash flow each year is rupees 1.5 lakhs. That means year one, this is the example. So now in year one, she will get 1.5 lakhs. In year two also, she will get 1.5 lakhs. So she is able to earn 3 lakhs in 2 years. So that means the payback period is equal to 2 years. Okay, so this is what is the payback period. So in 2 years, I'm able to earn back the initial investment that I put in the business, that is 3 lakhs. Great job. Now, ma'am, this is the concept. How to now, use the formula. When the cash flows are the same every year, it is going to be initial investment divided by CFAT. Initial investment divided by CFAT. CFAT means what? Cash flows after tax. This is what? Payback period when cash flows are same every year. Ma'am, how can that be? Cash flows, how they can be same every year? Say, for example, I've signed a government contract. Okay. And every year, this is the cash flow that you will get. Like that, the government has told me. So, in some cases, it is possible that the cash flows are the same every year. In such cases, this is the formula. Ma'am, why? I will tell you how to remember the formula. We are not going to by hearted. How? In the previous example of puja, the initial investment was how much? 3 lakhs. And cash flow was how much? 1.5 lakhs. So, how will I substitute? 3 lakhs divided by 1.5 lakhs is equal to 2 years. Already I told you how it is 2 years. Now, I think the concept is even more clearer. So, 3 lakhs divided by 1.5 lakhs. What am I finding out? In 2 years, I will be getting back my initial investment. So, this is why this formula is there. I hope it is very clear for everyone. Now, ma'am, suppose CFAT is not given in the question. Why after tax? Why after tax? Because tax is also a cash outflow. No? That is why we say cash flows after tax. Okay. So, but even if I say cash flows, it is the meaning is after tax only. Okay. So now what we are going to do is how to find out CFAT if it is not given in the question. Adu nodanana. So how we will do is, say for example, profit is given to you. Profit before depreciation is given to us. Okay. Now, how to do CFAT? CFAT means cash flows after tax. First, I should subtract the depreciation. Ma'am, why are you subtracting depreciation? Because it is a non-cash item. Correct. Depreciation is a non-cash item. Why we call it as a non-cash item? Are we paying depreciation to anyone? No, it is a cost. We are not paying it to anyone. It is a non-cash item. Okay. So now what we will do is profit before depreciation togambittu. I'm subtracting depreciation andre. Then we will have profit after depreciation. Then what we should do? We should subtract interest. Given that EBIT, we will do minus interest. EBIT minus interest, we will get EBT. Minus tax, because I need cash flows after tax. Okay. So minus tax andre EAT. Ma'am, but you subtracted depreciation, which is a non-cash item. Correct. Now we will add back. That is plus depreciation. Why I am adding back? Because non-cash item I earlier subtracted. So now I am adding back. Ma'am, why you are doing this? Subtracting first and adding back next. Why you are doing like this means, listen very carefully. Why I am doing like that is for the purpose of tax. To calculate tax, no, I should subtract a depreciation. Depreciation is an allowable expense as per Income Tax Act 1961. So, depreciation I'm subtracting for the purpose of tax calculation because that is how Income Tax Act is framed. Now, after that, finally, because I know depreciation is a non-cash item, finally I will add back the depreciation. ಹಂಗ್ ಮಾಡಿದ್ರೆ ಏನ್ ಬರುತ್ತೆ EAT plus the depreciation we will get CFAT. So very simple. Profit before tax minus profit before depreciation minus depreciation, you will get profit after depreciation, minus interest, minus tax. Then you will add back depreciation again. So be very careful. Sometimes in the question, they can give you profit after depreciation. Sometimes in the question, they will give you profit before depreciation. So, ಎರಡೂನು ಬರ್ಬೋದು. So, either they would have given profit before or profit after depreciation. Please be very careful. If they have given profit before depreciation, we should subtract depreciation. If they have not given profit before depreciation, you cannot subtract depreciation, because it is always a profit after depreciation is already given, means already depreciation is subtracted. That is the meaning of it. Okay, so this is how we should calculate CFAT, cash flows after tax. Why we learned all this? Initial investment divided by CFAT is only payback period when cash flows are the same every year. Okay, now this much we all have understood. Now, because it is very simple, I have not done any problem in this. Conceptually, we have understood. Now we will go to the next one. How are we supposed to go ahead? Now, payback period when cash flows are not the same every year. Payback period when cash flows are not the same every year. It is equal to E plus B divided by C, where E is equal to the year just before reaching, the year just before reaching initial investment. B is equal to initial investment minus cumulative cash flow just before reaching initial investment. C is equal to cash flow of the year in which initial investment is reached. Cash flow of the year in which initial investment is reached. Okay, so first we will write down. I will tell you why this formula, what is the logic, everything. So first we will write down. Payback period when cash flows are not the same every year. That means 1 year it is 20,000. 1 year it is 30,000. Another year it is 40,000. Another year it is 33,000. Like that, when it keeps changing, then this formula we should use. Okay, why? We will see that. So kindly write down. We will learn it without by hearting the formula. Okay. So cash flows are the same every year means what is it? Every year 30,000 rupees we are getting means cash flows are the same every year. That is the meaning of it. Okay. Sure. Now I think it's quite clear. We have taken the notes of everything. Concept is very clear. Please feel free to ask any doubts that you may have. Okay. So now we will proceed to yes. So I want to do this method because we'll be covering payback period also. We'll be covering unadjusted rate of return, which is average rate of return also, and NPV also. Everything we will be covering. It is our study material question. Okay. Totally about 6 or 7 questions I have chosen. 6 questions I have chosen from capital budgeting. Out of that, mostly everything is past exam. 1 or 2 maybe from study material, because it is a very good problem. That is why I've chosen it. Okay. So now we will proceed to ABC and SK Limited is considering the purchase of a machine. Two machines, X and Y, are available, each costing 50,000 Salvage value is estimated at 3,000 and 2,000 respectively. Earnings after taxation are expected to be as follows. Okay. So now evaluate the two alternatives according to payback period, unadjusted rate of return, and NPV when the discount rate is 10%. Okay. Now, before I proceed, some of you, generally ask me questions regarding, ma'am, if we have a discount rate of 10%, what is the meaning of that? Already we have learned in time value of money, but students who have not attended the regular class have this doubt. Oh, now let us understand what is the meaning of this. Now, it is due to time value of money. We are taking this concept. Quickly, let us go through time value of money in simple terms. TVM stands for time value of money. It says that the value of money constantly deteriorates. Okay. Let us understand how. Okay. So now, what is the price of 1 kg mangoes? Of course, there are various variety of mangoes, but just let us take in 2026, variety of mango, say for example, is 250 rupees per kg. Okay. Now, somewhere when our grandparents were buying, say for example, in 1960, maybe the same variety, okay, the price of mangoes, maybe say for example, 25 rupees per kg, just for our understanding, maybe even lesser than that. Let us take 10 rupees, okay, happy? Okay. So let us take 10 rupees per kg. Okay. Let us the same mangoes. Have the mangoes changed in terms of taste, color? Then we are paying 250 rupees. They paid only 10 rupees for the same 1 kg mangoes. Okay. So that means the money value has deteriorated. No. Yes, it has deteriorated. For the same mangoes, they paid only 10 rupees. We have to pay 250 rupees for the same mangoes. So it is due to depreciation in money. Okay. Some children are not convinced with this example. It happens normally. Now we will see the next example. With the next example, everybody will be convinced. Okay. Now we are playing a game. So team A, say for example, offline students, and team B, say for example, online students. Just an example. Okay. Now say that, online students have a score. Score is going to be 100 and 200. Okay, this is the score. Okay. Now, based on the score, I am saying that, okay, or, just imagine the score in your mind, otherwise, it may get confused, right? So, imagine that team B is leading. Okay, team B is leading. Okay, online students. Now, you all can see this water bottle, I believe. So, in order to buy this flask, right, this Chotu flask, I am saying that team B has to give me only 50 game coins. So, if you give me 50 game coins, I will give you this flask. Okay. But team A, you have to give me, 100 game coins because your score is less, no? You have to give 100 game coins to get the same water bottle. That means who is doing better? Who is doing better? Team B is doing better, right? Same way, can I say 1960, that prize was doing better, right? That prize was doing better. So again, I'm saying 50 game coins, they could get one water bottle, online students. But offline students, because of the game, they got low scores. No, because of that, 100 game coins you people have to give to buy the same flask. So, which means team B is performing better. Only 50 game coins they have to give. Same way, our grandparents had to give only 10 rupees for the 1 kg of mango. So, they were doing better. That means now the value has deteriorated. So, to buy the same 1 kg mangoes, I have to give 250 rupees. They gave only 10 rupees. Okay. So the value of money has deteriorated. This is what we call it as time value of money. Okay. So in the interest formula, okay, simple interest, compound interest formula, which we have done in regular class, the same thing here. Future value is equal to present value into 1 plus r to the power of n. We all know this compound interest formula. That means, can I write present value divided by 1 plus r to the power of n is equal to present value? Yes, we can. So this only we will be using. That is why we are saying, if it is 10 percentage, no, if it is 10 percentage, 1 divided by 1 plus 10 percentage to the power of 1 for year 1, n will be 1 is equal to present value. Ma'am, why future value you have taken it as 1? We are seeing for every 1 rupee, okay, what is the present value for year 1, year 2, year 3? So same way for year 2 it will be what? 1 divided by, instead of 10%, I can say 0.1. No. So 1 plus 0.1 to the power of 2. Because year 2, no. So n is also 2. Okay. So like that, we have to now understand. So 1 divided by 1 plus r. R is 10 percentage, 0.1 to the power of n. N is for year 1, it will be 1. For year 2, it will be 2. N. So for year 3, n will be 3 and so on. Okay. So that is why we used to do in our calculator 1 divided by 1.10 press equal to 1 time 0.909 we will get. Okay. Press equal to another time we will get 1 divided by 1.10 to the power of 2, 0.826 and so on. So this is the logic behind that discount rate. It denotes nothing but the depreciation in the value of money, which has to be calculated this way. I told depreciation in the value of money for the purpose of our understanding, but it's called as time value of money and so on. Okay. The reason for time value of money is inflation, mainly, as well as purchasing power parity, which other contributes to the same. Okay. So now let us come back to the payback period. Yes, yes. Anyone who wants to make note of these, quickly make note of these. This just for conceptual clarity. Oh, so now we will proceed to the next step. That is using this. Let us do the three things. Now I will do only for machine X. You at home will do for machine Y. Okay. So we should cover all the concepts, right? So homework will be machine Y. Machine X, I will do A, B, C, all the things. Okay. So today itself, after going back home, please do that. Okay. Now, payback period is what I have asked in A. So you all have the PDF and online students. It will be given in the description. Yeah, okay. So now having said all this, we have 15, 20, 25, 15 and 10, right? You can see the cash flows are not the same every year, correct? Because they have said earnings after taxation. That means I will assume that it is cash flows. Okay. So the cash flows are unequal. They are not the same every year, means we made note of the formula just now. I hope you people are able to remember. This is the formula E plus B divided by C. So I'm going to use that formula because the cash flows are not the same every year. Suppose every year it was same, different formula we'll use as discussed. E plus B divided by C. Okay. So where E is equal to, I'll do one thing. I'll just write down the cash flows and directly we can start discussing. Okay. So now, what is E? So for machine X, let me write year, cash flow, and cumulative cash flow. So cumulative means accumulation, nothing but addition. Whenever we are doing payback period method, cumulative cash flow has to be returned. Okay. We have years 1, 2, 3, 4, and 5. And the cash flows are 15,000, 20,000, 25,000, 15,000, and 10,000. Now, the scrap value is also given in the question. Okay. So the scrap value is given to be 3,000 in the first line of the question. All of you can see that first few lines of the question. And why we have added it in the last year? Scrap value means the value that we can realize at the time of sale of the asset. I'm buying a television for 50,000. I will expect the television to come with me for next 5 years. That means life is 5. At the end of 5 years, I can sell it for 3,000. That is what is scrap value. So that is also an income, no? So that is why we have added, assuming that is also cash flow. Okay. Now, cumulative cash flow will be what? 15,000. 15,000 plus 20,000, that is going to be 35,000. 35,000 plus 25,000 will be 60,000. 60,000 plus 15,000 will be 75,000. 75,000 plus 13,000 is 88,000. So we have calculated everything. Now let us see how to substitute E plus B divided by C. Now, what is the initial investment for machine X? See, for sometimes machine X and machine Y may have different initial investment. Two different machines may have two different initial investment. You have to check the question very carefully. Now, I will go and show you what is the initial investment. Can you all see? Each costing 50,000. That means the machine initial investment cost is 50,000. Okay. So initial investment is equal to 50,000. So where this 50,000 is falling? Between 2 and 3. So my payback period, it is the time period to get back my initial investment. So initial investment is 50,000. Between second and third years, I'm getting my payback period. Okay, that much have we all understood. 50,000 is falling between second and third year. Okay, but what is this E? E is, I will just remind you by showing here, the year just before reaching the initial investment. So I want the exact time. That is why I'm applying the formula, although we know it is between 2 and 3. So it is going to be, all of you please listen carefully. Year just before reaching the payback period. When are we reaching the payback period? In the third year, somewhere we are reaching in the third year. Are we reaching in second year? No. Second year, we are getting only 35,000. But I need how much? 50,000. So we are reaching in the third year only. Okay. So that means, can I say E is equal to 2? Why? Because the year just before reaching the initial investment. So I'm reaching initial investment in third year. So second year will be my E. Okay. Plus B. B is equal to initial investment minus cumulative cash flow just before reaching initial investment. Initial investment is how much? 50,000 minus cumulative cash flow before reaching is how much? That is 35,000. Cumulative cash flow nalli, we are having 60,000 also, 35,000 also. But what is it? Just before reaching initial investment, that year's cumulative cash flow I want. So it is going to be corresponding to second year 35,000. Ma'am, why you are doing 50,000 minus 35,000? Let us understand. Now, 50,000 totally I need. Okay, that is my initial investment. 35,000 I have earned in the second year, which means 50,000 minus 35,000. 15,000 I have to reach from the next year. That is why we are doing this. Again, I'm saying 50 minus 35. 15,000 I have to earn from the third year. That is why we are doing B. This is 50 minus 35 divided by C. C is the cash flow in which the initial investment is earned. C is the cash flow in which initial investment is earned. So what is the cash flow? 25,000 in the third year. Because in third year only we are reaching the initial investment. And mind you, C is not cumulative. C is just a cash flow. So whatever we wrote here, we have substituted. I hope it is very clear. So it is going to be divided by 25,000. So it is going to be 2 plus 15,000 divided by 25,000. So it is going to be 2.6 years. So even if you write it as fraction also okay. 2.6 years also okay. Even if you write it as months also it is okay. All are the same. Okay. So this is how we should calculate the payback period. Now we have learned the logic also. 15,000 out of 25,000 gives me zero point 0.6 years from the third year. That is why we are doing like that. Okay. So logically also we understood the formula. No need to by heart them. Now, some students asked me specifically to this problem because we have solved it in the regular class. Ma'am, they have not asked for post payback profitability, but they are calculated in the solution. See, as far as the exam is concerned, they will not ask you to do anything extraordinary. That is, whatever they asked only, you should answer to. Whichever is not asked and all, no need to answer. But I will just tell you. The question is mission X or mission Y. That is the question. No. So, shorter the payback period, the better it is. Shorter the payback period, the better it is. Ma'am, why? See, I invested 5 lakhs. Okay. So now I am getting in one business, I am getting it back in 2 years. Another business, I am getting it back in 4 years. Okay. Which one will I prefer? The business which gave me the initial investment in 2 years. Very simple, ma'am. Now we have Manoj, we have Ashmita. So Manoj is investing in the business and he is getting back his initial investment in 2 years. Ashmita is getting back in 3 years. Which is better? Manoj is better. But I can say this only when the initial investment is same for Manoj and Ashmita. If it is not the same, I cannot conclude like that because assume that you know, generally speaking, shorter the payback period, the better it is. No doubt about it. But assume Manoj's initial investment is 10 lakhs. Ashmita's initial investment is 1 crore. Correct. It makes a difference, right? So that is the reason why we need to calculate post payback profitability if the initial investment are not the same. But in this question, 50,000 for each of the machines is what we learned. I will show it to you. Here, the initial investment for project for machine X and Y is the same. X and Y, each costing 50,000. It is the same. So, no need. But just because the doubt has come, I will tell you how to calculate post payback profitability. Post payback profitability or post payback profit is equal to total cash flow minus initial investment. Total cash flow minus initial investment. Okay. So now how to do this? Okay. So why, ma'am, post payback profitability is equal to total cash flow minus initial investment means up to 2.6 years, I was only earning back whatever I invested. After that only I'm going to make profit. No, that is what is post payback. That means after payback, what is my profitability? So totally I earned 88,000. I earned how much? 88,000, including my scrap value. 88,000 minus initial investment is equal to how much? Initial investment is 50,000. So 38,000 is the post payback profitability for machine X. So totally I got 88,000. Out of that 50,000 is initial investment itself. That means only 38,000 is my profit. But here you can choose to consider scrap value or not. Okay, because it is not a profit like that also you can argue. So choosing that is you can either use 88,000 or 85,000 without scrap value in the last year I'm saying. Okay. So this is how you should do. But post payback profitability is more important when, yes, the initial investment is not the same for two machines or two projects. That time only it is more useful. Okay. So we have done this payback period. Now, unadjusted rate of return method. So that also I will explain. So I'm going back to the checklist and telling you what and all we completed conceptually. So conceptually, we have completed in the checklist. We have completed payback period when cash flows are the same every year. I explained to you how to calculate CFAT, what is the formula, why the formula, everything. Payback period cash flows are unequal. I have explained that also. When cash flows are unequal, just now we did E plus B divided by C. Why that formula also we have learned. Now I will do ARR. I will come back to discounted payback period method after I finish ARR. Now, and security analysis is a place where time and again theory questions are asked. So please give importance to that chapter's theory. Okay, in general, theory can be very helpful. So, yes, unadjusted rate of return or accounting rate of return method. This is the method. Ma'am, why that word unadjusted? I will tell you. Now, it is going to be what is the formula? The formula is average profits minus annual depreciation divided by average investment. Now, this is very similar to return on investment formula. What is return on investment? Return divided by investment. Simple, ma. You are investing in share market. Monica is investing in share market. Okay. She invested 1 lakh. She got returns of 5,000. How much is her return on investment? 5,000 divided by 1 lakh, whatever percentage you're getting. Same way here also. We are taking average profits. Okay. Profit is our return in the business, no? Minus annual depreciation. Yeah, okay. Depreciation, I do not consider because it is a non cash item. I don't want to consider it. Okay. Yes. Divided by average investment. That investment, instead of taking 1 lakh, I'm taking average investment because beginning and end, the investment can be different. So I'm taking average. So this is the logic. Return on investment formula. We have modified and said it as adjusted rate of return method. Okay. Now let us understand. I told you about time value of money. We discussed about what is the discount rate at the rate of 10 percentage. Everything we discussed. In payback period method, did I use it? In accounting rate of return method, are we using it? No. So remember very carefully. The time value of money is not considered in two methods. One is payback period method, another one is accounting rate of return method. In these two methods, we will not use payback period. So, I'm so sorry. We will not use time value of money. We will not use time value of money. Ma'am, why? That is how these, strategies are. So in some places, some strategies will work. Payback period is a quick measure. Accounting rate of return is also quick measure. Okay, so there might be a theory question. Explain the capital budgeting techniques which do not consider the time value of money. or which ignores the time value of money. Okay. In such cases, we should write payback period as well as adjusted rate of return. These two methods are not considering time value of money. The 10% discount, we didn't use it. Okay. So that is why ARR method is having another word, that is unadjusted rate of return. It is not adjusting time value of money. That is why unadjusted rate of return method. Okay. So this is how we should use. That is why I didn't use the word cash flows. I've used the word profits here. Okay. So minus annual depreciation. So this is the formula. Very easy. Now let's go back to the question and see how we have to go to answer this. So again, I will be doing for machine X and machine Y, you people can take care of at home. So A is over. A, the answer was 2.6 years. If the initial investments are different in the exam for machine X and machine Y, please do post payback profitability also. So in capital budgeting, such a question you may expect in the compulsory question also. Generally, compulsory question little more challenging. Today we will be doing those challenging questions also. But what I'm trying to communicate here is that because it is having multiple, ways of multiple places of testing, so you can definitely go through that. Not an issue. Okay, because they are testing you on payback period, ARR, as well as NPV. There may be few more questions along with that for the compulsory question. So now we will proceed to, so sometimes theory can be difficult. Sometimes corporate accounting can be difficult. So your FM may be easy. Other way around may also happen. So we should be prepared for everything. So some students tell me, ma'am, FM I have understood very well. So corporate accounting I will prepare a little less. No, in professional exams we can't take such uh, doubts at all. We can't do that. So now UARR is equal to average profits minus annual depreciation divided by average investment. Machine X. Let us find out the average profits. How to do simple average? How we'll do average of marks? We'll add all the marks divided by the number of subjects. No, same way here also. For machine X, I will add 15,000 plus 20,000 plus 25,000 plus 15,000 plus 10,000 divided by 5. Average profits. Ma'am, why didn't you take scrap value? See, the correct way of learning it is profits. I have not said cash flows. Scrap value is not my profit. That is why I didn't consider. Okay. But in the textbook, in some places, they have used the word profit. In some places, they have used the word cash flow. So anything, even if a child is writing average cash flow also, chalega, no problem. Okay. All right. So now 15,000 plus 20,000 plus 25,000 plus 15,000 plus 10,000. So it is going to be 85,000 divided by 5. Yes. So it is 17,000. So we got one item, that is average profits agogi there. Now we will go for annual depreciation. Same thing in accounts, whatever you have learned for depreciation, that is cost minus scrap value divided by life. Okay. So cost is going to be 50,000. Scrap value is 3,000. Only for machine X we are doing. Life is going to be, it is given that it is 5 years now. You all can see that cash flows is generated for 5 years. Okay. So now divided by 5. So correct. So 9,400. That is the depreciation. 9,400. We have learned how to use, many shortcuts in the calculator in the regular classes. Please use your calculators when you're actually practicing for the exam. Yes. Okay. So then average investment is equal to opening plus closing divided by 2. What is opening plus closing? Initially, how much I'm investing in the business? 50,000. At the end, how much I'm getting back from the business? Scrap value. Initially, I'm putting in 50,000. After 5 years, I will be getting back 3,000. So that is going to be how much? 50,000, 53,000 divided by, that is 26,500. So now we will proceed. So for machine X, we got average profits also, annual depreciation also, average investment also. With all of this, let us do. Unadjusted rate of return method for the machine X is going to be 17,000 minus 9,400 divided by 26,500. So it is going to be 28.67 percentage. It is always a percentage. So we can express it this way. So I hope it is very clear to all of us. Okay, unadjusted rate of return method is also very simple. Why I chose this is because many times students are focusing on NPV, only on past exam questions. So going through doing past exam question is not a bad thing, but already it is asked. So they may ask a place where they have not asked from. So that is why the checklist is very important, which we have written in the beginning of the class. Now, shallow students. So this is also done. So now let us do net present value. Okay. So net present value also I will teach. Then discounted payback I will teach. Okay. Net present value. That is equal to what? Present value of inflows minus present value of outflows. Correct. What you people are saying is also correct only. That is usually in regular classes, we have learned it this way. It's very comfortable for other students also. So let us write it. In other words, you can call it as NPV is equal to total of DCF, discounted cash flows minus initial investment. That is only present value of inflows. Present value of outflows is only initial investment. So you can learn NPV in whichever manner you want. Even if a child does not know what is NPV, now you can learn it. But most of you will know it is very simple only. So it is going to be cash flow, PVF at 10 percentage, DCF year. These are the four columns that we should draw. Okay. Now, PVF, ma'am, how to calculate? I already told you some time back. You all remember PV is equal to FV divided by 1 plus R to the power of N, the compound interest formula that I was talking to you about. So for time value of money, when I explained, I have told this. So this one, I'm not repeating because we are in a marathon. We have to cover all the concepts. So those of you who missed it, please pause and you can, see the recording. Sometime back only I've done this. Okay. So it is going to be, they have given at the rate of 10% in the question. We have not assumed it, right? They'll always give it the rate. Sometimes they may give you the PV factor also. So it is going to be, when you do it continuously, you will know the values, especially for 10% and all that. So 0.909, 1 divided by 1.10 equal to 1 time 0.909, 0.826, 0.751, 0.683, right? And 0.621. Yes. So now we will write down the cash flows. The cash flows are going to be what, students? Let me refer to the question. It is 15,000, 20,000, 25,000, 15,000, 10,000, not to forget, plus the scrap value. Very nice. 3,000. We are doing it only for machine X. So let us quickly finish off the DCF. What is DCF? Cash flow into present value factor. So the meaning is the value of 1 rupee at the end of 1 year is equal to 0.909 now. Okay, so the present value is 0.909. In other words, what you are able to buy for 0.909 now, you should pay 1 rupee after year 1. Okay, so now 15,000 into 0.909. That is going to be 13,635. 20,000 into 0.826. That is going to be 16,520. 25,000 into 0.751. That is going to be 18,775. 15,000 into 0.683. That is 10,245. 13,000 into 0.621. That is 8073. Now we will add all of them. So 13,635. Now I have to make the decision whether to buy the machine or not, which machine to buy. That is why we are taking present value. 13,635 plus 16,520 plus 18,775 plus 10,245 plus 8073. We are getting 67,248. This is the total of DCF. So, present value terms nully, we are getting 67,248. The inflows. So, now 67,248. The total of DCF is 67,248 minus initial investment is how much? 50,000. Ma'am, why didn't you do any PVF for 50,000? Because 50,000 is invested right now. Already it is now only. No need of any present value. Already it is present value. So now 67,428 minus 50,000 is 17,248 is the net present value. 17,248 is the net present value for machine X. Greater the NPV, the better it is. Greater the NPV, the better it is. So the acceptability criteria, that means we know, ma'am, now what is NPV? What is the acceptability criteria when we should accept a project? If NPV is greater than 0, accept. If NPV is less than 0, reject. That means it is a loss, Alma. So that is why we're rejecting the project. NPV is less than 0 means if it is in minus, then you have to reject. NPV is equal to 0 is indifferent. Okay. No comments. You can either accept or reject. No problem. So this is the acceptability criteria. So since NPV of machine X is greater than 0, accept it. But when you are comparing which machine is better, X or Y, it is not X and Y. If you are comparing X or Y, Andre, greater the NPV, the better it is. So if machine X is having NPV of 17,248 and suppose machine Y is having 10,000, just an assumption, then machine X is preferred. Greater the NPV, the better it is. So we have done this also. So this problem fully we have answered. It's a good question because many people are ignoring the payback period and unadjusted rate of return method. They may ask you on this. So now, so ARR is also done. Here NPV is done. You all can see NPV is over. Oh. Discounted payback period. I will explain this. Okay. We all know payback period nully one disadvantage is there, one limitation. What is the limitation? It does not consider time value of money. That is one disadvantage. Okay. Payback period as well as unadjusted rate of return method does not consider time value of money. Okay. Now there is a solution to this. What is the solution? There is a problem means obviously there will be a solution. The solution is discounted payback period. How we need to do it? How we need to do is here, suppose we have 1, 2, 3 years. Cash flows is going to be 10,000, 10,000, 10,000. Ma'am, cash flows are same. But if the question says I want discounted payback period, then I can't use initial investment divided by CF18. I should use PVF at the rate of 10% ಮಾಡಬಿಟ್ಟು discounted cash flow ಮಾಡಬೇಕು. Then I will do cumulative discounted cash flow. Like that I should do. So assume initial investment is equal to 20,000. Just an assumption. This is an example for discounted cash flow. Ma'am, why I didn't write any formula? Formula is the same. E plus B divided by C. So, ma'am, cash flows are the same. No problem. Now it will change. So it is going to be 0.909, 10 percentage, 1 divided by 1.10, 0.826, 0.751. So this will be 9090. This will be 8260. This will be 7510. Now, 9090 plus 8260. That is 17350. 9090. 17350 plus 7510. It is 24860. So instead of doing all the calculation on cash flows, all our calculation will be on discounted cash flows. So, how to calculate discounted cash flow? Discounted cash flow, discounted payback period nully. It is going to be E plus B divided by C. By now, all of you are very familiar with what is E, B, and C. Okay. Again, if you are not familiar, just sometime back I've done, you can visit the recordings. Okay. So now it is going to be E is the year just before reaching the initial investment. Initial investment is 20,000. So I'm reaching somewhere in the third year. Okay. So that means 1 year before means second. So E is equal to 2. So E is equal to 2 plus B is equal to initial investment minus cumulative cash flow of second year. Okay. I chosen 2, no? So the corresponding cumulative discounted cash flows. So it is going to be initial investment 20,000 minus, I should take cumulative discounted cash flows. That is 17,350 divided by, we will write cash flow of the year in which we have received the initial investment. No. So Mamulagi, we will take 10,000. But here we should not take 10,000. We should take 7510 discounted cash flows. So 20,000 minus 17,350 divided by 7510, it is 0.35. So it is going to be 2.35 years. That is the discounted payback period. Okay, ma'am, when I should use this? Students, if they ask you payback period, you will do only payback period. If they ask you discounted payback period, then only you should do discounted payback period. Because there was one child who said, ma'am, it is a disadvantage. No. So they asked me payback period, but in the exam, they have asked payback period. That person has done discounted payback period. No, ma. I told you the reason why we have discounted payback period, but it depends on what they are asking you in the exam. Okay. So conceptually, all this is clear. Now, we have done this checklist also, discounted payback period also, Madidvi Navo. Now, I will go to start the past exam problems one by one. We will cover all the basic concepts. Okay. All right. So equipment A has a cost of 75,000 and net cash flow of 20,000 per year for 6 years. Okay. So now what is it? All of you, please listen very carefully. It's a past exam question. Okay. Many years ago, it was asked. Um, but why I chose many years ago is recently, whatever is there in the past exam, that also I've included, but we have all solved most of them in the test, right? So again, they may ask these exams or questions also about 2013-14, the year 2013-14, they have asked these questions before MCQs were there. Okay. So now here, equipment A has a cost of 75,000. Initial investment is 75,000. Net cash flow of 20,000 per year. That means every year the cash flow is same. If I say, will you all agree with me? Yes. Every year the cash flow is 20,000. Suit and life is going to be 6 years. A substitute of equipment B would cost 50,000. ಸೊ ಎಕ್ವಿಪ್ಮೆಂಟ್ ಎ ಇಲ್ಲ ಅಂದ್ರೆ ಬಿ ಬರುತ್ತೆ. ಬಿಗೆ 14,000 per year for 6 years. Okay, 14,000 per year for 6 years. Okay. The required rate of return for both the equipment is 11 percentage. Okay. When net present value and profitability index, calculate net present value and profitability index for both the, and which equipment should be accepted and why. Okay. Now we have to do both the equipments. Just give me 1 minute. I'll have some water and mix. If you have any questions, online students, or if you want me to go a little more slow and little bit slow, Andre, please tell me. Because conceptual clarity is very, very important. More than anything else, this is only very, very important. Yeah, I think there are no doubts. So I'll continue now. Equipment A and equipment B. Cost is given to be 75,000 and 50,000. And life is going to be 6 years and 6 years. Cash flow per year. That means cash flow is the same every year. Cash flow per year, andre every year same cash flows. Okay. What is that term? It is given to be 20,000 for A, equipment A, and 14,000 for equipment B. And the rate of return is 11 percentage, means discount factor is 11 percentage. So discounting factor is at the rate of 11 percentage. So if you write what is given in the question itself, you will be half clear, okay, with the concepts. Okay. So now they have asked us to calculate in the question, they have asked us to calculate NPV and PI. NPV means net present value, PI means profitability index. Let us see how we need to do. NPV. NPV, though, all of you know how to do. It is going to be total of DCF minus initial investment, or present value of inflows minus present value of outflows. You can tell however you want, no problem. Okay. Now, let us see how we need to go about this. Now, cash flows are the same every year, means we can use what is called as annuity factor. Ma'am, what is annuity factor? We have learned in the regular batch, but we forgot. No problem. Annuity factor means total of present value factor. When you can use it only when cash flows are same every year. Andre, all of you ನೋಡಿ, cash flow is going to be what? 20,000 for equipment A, 20,000, 20,000, 20,000, like that it will go for 6 years. Present value factor at the rate of 11 percentage. They have given in the question, Alva. One minute, I'll open the question. Point 901, point 612. One minute. I'll just open it here. It's a little difficult to just see there and here. I got the question. Yes. So not 612, it is 812. I'm sorry. 0.731 and so on. No. Now, 20,000 common factor ಇದೆ ಅಲ್ವಾ? ಏನ್ ಮಾಡ್ಬೇಕು ಈಗ? Normally, ಮಾಮೂಲಾಗಿ what we will do 20,000 into 20,000 into 0.901. Then we will do 20,000 into 0.8812. Like that, we will keep doing everywhere. Then we will add, isn't it? 20,000 into 0.731. Instead of adding separately, what they're saying is 20,000 you take outside the bracket and 0.901 plus 0.812 plus 0.731. Like that, you can do for 6 years, right? But we can do this only when the cash flows are same every year. So this, when you add only, we will call it as annuity factor. So how to do in the calc? If you have forgotten, I will tell you. So press 1 divided by 1.111 equal to 6 times. See, in this question they have given, suppose they don't give means how to do, I'm saying. Then press GT, grand total, correct? Then you will get the annuity factor. Suppose you don't have GT, I'm saying when the rate is not given in the question, how you can do in the calculator. Press 1 divided by 1.11 equal to memory plus. Like that, you have to do for 6 times. Equal to 1 time, memory plus 1 time. Like that, 6 times. Okay. Then you will get the annuity factor. So please go back and check. And if you have any doubts, please let me know. Okay. So now let us see how we need to do. Here, everything is given in the question, Alva. Everything is given in the question. Now let us see how to do. We will just add whatever is given to us. Okay, because the cash flows are the same every year. So now, yes. If we add 0.901 plus 0.812 plus 0.731 plus 0.659 minus 0.593 plus 0.535, we will get 4.231. So from here, I'm continuing. We are going to do for equipment A first. What are we going to calculate? NPV. NPV, we need total of DCF. For that only, we are doing this total of DCF only. We are using this concept, that is cash flow into total of PVF, because the cash flow is the same every year minus initial investment. NPV is equal to total of DCF minus initial investment. Okay. Cash flow into total of PVF, how to do? Cash flow for equipment is 20,000 into 0.901 plus 0.812 plus 0.731 plus 0.659 plus 0.593 plus 0.535 minus initial investment. How much is the initial investment? 75,000. So I hope everybody has understood this. So I told you the calculator shortcut and all if the rate is not given in the question. Okay. So it is going to be 4.231 into 20,000. That is 84,620 minus 75,000. For equipment A, the NPV is going to be 9620. So same way, let us calculate NPV for equipment B also. Then we will go to the profitability index. After this, we will be doing a complex problem, which is capable of being asked in the compulsory question. Okay, in capital budgeting, it may come. Okay, now equipment B. Equipment B, how to do? Let us understand that. Equipment B, again, NPV is equal to total of DCF minus initial investment. Total of DCF, we know it is cash flow into total PVF minus initial investment. Oh, so now when we can do total PVF only when the cash flows are the same every year. Yes, no. Why I'm going on repeating is if the cash flows are the same every year, don't waste your time. You can do it like this in the exam. That is why. For equipment B, the cash flow given in the question is going to be 14,000 into total of PVF. Just now I did. PVF will not change, no, 11% only, no. Total of PVF, just now we did. It is going to be 4.231. That is what I got. Yes, 4.231. Minus initial investment for B. What is the initial investment for B? 50,000. Okay. So 14,000 is given in the question. 4.231 just by adding the PVF. Just now we got initial investment is also given in the question. So 59,234 minus 50,000. That is equal to 9234. This is the NPV of equipment D. Up to this, is everything clear? Let me know if there are any questions. Let me know if there are any questions. Oh, so it is very clear, very nice. So now we will go to tell about profitability index. That is also there in our checklist. So why we need a profitability index? NPV itself is sufficient. Why we need it, when we need it, all that we will discuss. Profitability index is equal to present value of inflows divided by present value of outflows. In other words, total of DCF divided by initial investment. So in NPV, we subtracted. In profitability index, we have to divide. That's all. Ma'am, why we should do this? When we should do this? Let me tell you. When initial investment of two projects are different, or when there are unequal lives, then we should use profitability index. See, if there is a challenging question, they may not even tell you calculate profitability index anta. Indirectly, they may tell you, they will just tell you decide which one is better. So discount factor is given means you have to use NPV or TI or IR. IRR though not required because already discount factor is given. So NPV or TI only you should use. You should know when to use it. Okay. When to use. Listen very carefully. Two projects here, two equipments we are having. Initial investment of equipment A was how much? 75,000. B was how much? 50,000. They are different too. How I can compare directly? So that is when I will use profitability index. ಓಕೆ ಸೊ ಇಷ್ಟು ಇನ್ವೆಸ್ಟ್ಮೆಂಟ್ಗೆ ಎಷ್ಟು ಪ್ರೆಸೆಂಟ್ ವ್ಯಾಲ್ಯೂ ಬಂದಿದೆ ಅಂತ ನೋಡಕ್ಕೆ ಅದಕ್ಕೋಸ್ಕರ ವಿ ನೀಡ್ ಪ್ರಾಫಿಟಬಿಲಿಟಿ ಇಂಡೆಕ್ಸ್. ಓಕೆ ಸರ್, ಅನ್ಈಕ್ವಲ್ ಲೈಫ್ಸ್ ಅಂದ್ರೆ ಏನು ಮೇಡಮ್? ಇಲ್ಲಿ ಫಾರ್ ಎಕ್ವಿಪ್ಮೆಂಟ್ ಎ ಆಲ್ಸೋ 6 years, ಫಾರ್ ಬಿ ಆಲ್ಸೋ 6 years, ದೆನ್ ಡೈರೆಕ್ಟ್ ಆಗಿ ಕಂಪೇರ್ ಮಾಡಬಹುದು. ಸಪೋಸ್ ವಿ ಹ್ಯಾವ್ ಎಕ್ವಿಪ್ಮೆಂಟ್ ಎ ಗೆ ವಿ ಆರ್ ಹ್ಯಾವಿಂಗ್ 6 years, equipment B ಗೆ we are having 4 years andre, then also profitability index have to be used. Okay, so even if the question is not mentioned, especially in a compulsory compulsory question, I'm sorry, compulsory question, you may have to apply your mind when profitability index will be used. Okay, so whenever the two projects initial investment is different, cost is different, or when there are unequal lives, NPV ಸಾಕಾಗಲ್ಲ, you have to do profitability index. Profitability index, very easy to remember. Whatever you subtracted in NPV, you have to divide here. That's all. Extremely simple. Now, in this question, 75,000 initial investment for A. For B, it is 50,000. It is different, alva. Adukoskara, we have to do PI, profitability index. So, how to do? Let us understand. So I'm going back to what I have done. Profitability index is going to be 84,621 divided by 75,000. Total of DCF divided by initial investment. So 84,621 divided by 75,000 is equal to 1.13. Profitability index is equal to 59,234. That is total of DCF divided by initial investment. 59,234 divided by 50,000. That is 1.18. Right, dears. Good. So now we will go ahead. I think it is very simple. So in the checklist, profitability index is also over. So now, yeah, I forgot to see the next subdivision. Next subdivision, what they have asked, which equipment should be accepted and why? So that also let us say, conclusion. How to write the conclusion? Equipment A, equipment B, NPV and PI. Decision. NPV was how much? Yes, no, 9620 and 9234. So equipment A is a better option because greater the NPV, the better it is. Acceptability criteria is greater than 0. Both are greater than 0. Whichever is, having greater NPV, the better it is. This is 1.13. This is 1.18. And acceptability criteria for profitability index, please write down. Forgot to teach you. Acceptability criteria for profitability index, yes, whatever we have done in regular class. So it is going to be PI is greater than 1 means accept. PI is less than 1 means reject. Equal to 1 means indifferent. Okay, so this also we have done. So as per this, equipment B is better. It is having greater profitability index. Now, this is how you will conclude. One more conclusion I will tell you how to go further also. As per NPV, A is better. As per profitability index, B is better. Ma'am, which one should I choose? I will tell you that. Now, NPV is a better decision making tool. So, NPV choice is preferred over profitability index choice. So, I will say equipment A is better. Because generally speaking, although capital is different and all that, NPV is a quicker decision making tool and faster for reference. But when there is capital, when there is capital rationing, then TI is preferred. What is capital rationing? Now, I am having only 10 lakhs in my I don't know, my investment, my capital is only 10 lakhs. I can't invest in all projects, no. So I'm having five projects A, B, C, D, E. How to now decide which projects I can choose? Okay. So, say for example, each one is 2 lakhs. Each project cost is 2 lakhs, or let me say 2.5 lakhs. Each project cost is 2.5 lakhs. So, totally, I have to. So 12.5 lakhs we need totally. But I'm having how much? Only 10 lakhs. That means I will ration it. Which one? A is better or B is better based on profitability index. I will give them rank, and then accordingly I will give them rank based on profitability index. Accordingly, I will see this 10 lakhs has to be invested in which of the projects. Okay. So project divisibility, everything is discussed in theory in regular class. Those of you who are not unable to recall, please go through the theory. It is a theory only. Okay. So when there is capital rationing, then PI is preferred. So this is how you should conclude. So to some extent, I have told you the theory also. So now what and all is covered? I covered even capital rationing. That concept also. Concept. It's a theory that also we have covered. Okay. So in the regular class, of course, problems also we have done based on that. Okay. So past exam question, it is over. Okay. So when the cash flows are the same every year, please remember we can use GT or we can total the present value factors. Remember that. And when the capitals are different or unequal lives are there, then we can use profitability index. In case of capital rationing also, profitability index is preferred. One more thing that I wanted to say was there is a concept of EAB and or EAC, that is equated annual benefit or equated annual cost. It is discussed as a theory in the regular class as well as it is there in the theory notes. Please go through that. Okay, in this context. Okay. Now, this is a past exam question for 5 marks. Very simple it is. Again, I will do for option M in the class. Option N will be a homework because we are covering as much concepts as possible. Okay. So again, I'm saying it's not about how many problems we do. It is about the quality of problems that we do. So it is a past exam question, 5 marks. Recently only this was asked. First question was asked long years back. Okay. An investor is considering purchase of a new investment for 15 lakhs. Okay. The initial investment is 15 lakhs. Investor has two options, option M and option N. Okay. So these are the cash flows. Okay. Because they have said cash inflows. Okay. Investors target return is 12%. Risk premium is 3% and 7% for M and N. Okay. Now, this is what we call it as risk adjusted rate. That also I have given in the checklist. This risk adjusted rate only we are going to do now. Those of you who joined later on in the class now. The 8 points is the checklist. For every chapter, I'm giving a checklist. This and all you should know before going to the exam. Okay. So if you know the checklist, you know, okay, this much is only there. How much I have done, how much I'm yet to do. Like that, you will have a clarity. That is why we have this checklist. Risk adjusted rate andre ಏನು 12% and ಮಾಮೂಲ್ rate ಅದು. For option M, how much is the risk? I'm expecting another 3 percentage. So I will add it. So it is going to be 15 percentage. For option N, mamul rate is 12 percentage plus the risk is 7 percentage. So it is going to be 19 percentage. So the discount factor for option M will be 15 percentage. For option N, it will be 19 percentage. So they, to confuse this, they have given all the rates. But we should use what? 15% for option M and 19% for option N. That's all. Past exam question for 5 marks. So let us do. Very simple. We will calculate the NPV. Okay. Which investment should be preferred? That is what they have asked. Ma'am, they didn't tell me which one, whether to calculate NPV or profitability index or payback period. See, ma'am, whenever they have given the percentage of discount, obviously I should not use payback period, or I cannot even use ARR because they are not considering time value of money. So I should use what? Either NPV or profitability index. Life is the same, 5 years for option M and N. Initial investment is also the same for 15 lakhs for option M and N. That means I should use NPV. Okay. So let us start using the NPV. Let us see how to do this. NPV, I'm reminding the formula for you. Very good. Present value of inflows minus present value of outflows. Total of DCF minus initial investment. Anything is okay. Both are same actually. However, you want to remember it is okay. So I'll open the question here so that it becomes easy for both of us. So I hope everybody has written this part. This is very important. You should write this in the exam. Okay. Very nice. Yes, yes. We have done similar questions in the regular class. It is there in your textbook also. Option M. So discount rate at the rate of 15%. For N, okay, you will do what? 19%. Super. So it is going to be year, cash flows, PVF at 15 percentage, and then DCF. Because the life is the same 5 years for both the options, and the initial investment is also 15 lakhs for both the options. No need of profitability index. NPV is enough. So 1, 2, 3, 4, and 5. Cash flows is going to be 1,52,000, 2,36,000, 7 lakhs, 5 lakhs, 3,57,000. And already the discount rate is given. So I'm referring to the question. You can also refer to the question. Discount rates is given. So we will take it 0.870, 0.756, 0.658. Then we have 0.572 and 0.497. Good. I'm happy you're all enjoying FM. I'm happy to hear that. So let us now do the DCF. Come on. 1,52,000 into 0.870. That is 1,32,240. 2,36,000 into 0.756. 1,78,416. 7 lakhs. 4,66,600. Okay. 2,86,000. Is it? Okay. 86,000. And 1,77,429. Now, okay. So now we will do the total. Just one. It is going to be 12 lakh 34 685. Okay, this is the total of DCF. Oh, total of DCF minus initial investment. What is the initial investment? 15 lakhs. So 12 lakh 34 685 minus 15 lakhs negative. We are getting NPV of negative 2 lakh 65 315. If NPV is lesser than zero, we need to reject the project. NPV is less than zero. So reject. Less than zero, how? Negative, alva? Yes. So reject the project. Reject the option M. Reject option M. That's all. Quite simple. Option N, please do it as homework. But option N ಗೆ ಏನ್ ರೇಟ್ ಯೂಸ್ ಮಾಡಬೇಕು? 19%. Option N ಗೆ 19%. So 5 mark problem. Everybody can easily do it. Good. So now we will proceed to the next problem. So 2 past exam and 1 textbook problem done. Now we will do what? Capital budgeting. This problem only I was telling you, little bit challenging. It was asked previously for 12 marks. Okay. Long back, 2013-14, that time. So now also they can ask you in the first 20 marks. Out of that, they may ask you for 10 marks. 20 mark problems only. They may ask you for 10 marks. So all of you, pay full attention here. So why I chose this problem was many of you, when you did your exercise problems, you are told about the working capital. Why, ma'am, it is added back in the last year. I've explained to each and every one of you. Now, regular class students know it. But in case some child is having a doubt, that is why I chose this past exam question. Many years back, it was asked. Okay. So now Raghu Electronics wants to pick up a new project. Okay. So we have these information. So we have land to be incurred at the beginning of year one. Very good question it is. Okay. So beginning of year one means, can I say it is right now? Year zero. Yes, ma'am. End of year one means I will take 1 divided by 1.10, 0.909. That is end of year one. 10% I'm telling. Suppose it is beginning of year one means it is right now, no. So no need of present value. Take it directly. That amount of 2 lakhs can be taken directly. Okay. Then next is going to be building to be incurred at the end of 1 year. Building to be incurred at the end of 1 year. That means we will take 0.909, considering 10%. Machinery to be incurred at the end of year two. That means we will take 0.826, considering 10%. This and all is for understanding. Suppose, ma'am, I am not familiar with 0.909826 means, please wait. When I'm explaining the problem, you will understand. Then working capital, margin money, beginning of year three. That is also given to us. Okay. So beginning of year three is the same as end of year two. So it is very important to write down. Please write down. Beginning of year one is the same as year zero. Beginning of year one is the same as year zero. Beginning of year three is the same as end of year two. Beginning of year three is the same as end of year two. Okay. So all this very, very important because initial investment andre direct agi togobodu now. Even when I was explaining in the regular class, I used to tell you when you can use initial investment directly. So present value of outflows. So now initial investment is not done immediately. It is done in phases. For example, you are starting a cafe. Right now you are buying one small, building for 50 lakhs. Right now. That is the initial investment. After 1 year, you are buying a small, another room also along with the cafe. Okay, along with the building. You are buying another small room also for 10 lakhs. But this is after 2 years. That means present value togobekalma. It is not right now. So the investment is happening in phases. That is what we should understand. ಇನಿಷಿಯಲ್ ಆಗಿ ಎಲ್ಲ ಇನ್ವೆಸ್ಟ್ಮೆಂಟ್ ಆಗಿಲ್ಲ, ಫೇಸಸ್ ನಲ್ಲಿ ಇನಿಷಿಯಲ್ ಇನ್ವೆಸ್ಟ್ಮೆಂಟ್ ಆಗ್ತಾ ಇದೆ. ದಟ್ ಇಸ್ ವಾಟ್ ವಿ ಶುಡ್ ಅಂಡರ್ಸ್ಟ್ಯಾಂಡ್. Now, clear everybody, anybody has a doubt, online students also can tell me. Any doubts are there, please let me. Now, so now we will proceed to sales, variable cost, fixed cost, depreciation, everything is given to us. At the end of operational period, fixed assets can be sold for 5 lakhs without any profit. Okay. So then cost of capital of the firm is 10%. Tax rate is given. You're required to evaluate the proposal using present value approach and advise the firm. Okay. Net present value. That means NPV is what is required here. So students, NPV is equal to what? Present value of inflows minus present value of outflows, or total of DCF minus initial investment. I told you in some cases this will, we have to pay more attention. Here I will use present value of outflows because investment is happening in phases. Okay. How to do? Let us understand. Just give me one minute. Now, I'll open the question form. Now, present value of outflows. Slightly new to us, no? So, new to us in the sense, all questions are not like this, something different. Now, how to do this? Listen very carefully. What are all the outflows? First, refer to the question. Land is given. Beginning of year 1 is given to us. Okay. Then building is given. This is given to be end of year 1. And then machinery is given. Machinery is going to be end of year 2. So working capital, this is going to be beginning of year 3. So these are all the investments I need. I need money for land, building, machinery, working capital. 2 lakhs, 3 lakhs, 10 lakhs, 5 lakhs, all this we need. Total of 20 lakhs. 20 lakhs, no. Are we giving immediately? No. Some we are giving now, some later on. That is what is the difference between other questions and this question. Phased investment. Okay, full 20 lakhs. Iga kododilla. Okay. Beginning of year 1 means I can say it is the same as year 0. Year 0 means right now. Okay. Beginning of year 3 is the same as end of year 2. Okay. So this much we all understood. Now let us calculate the present value factor. In point number 4 in the question, want me to show it? Point number 4 in the question, they have said the cost of capital is 10%. Cost of capital is 10%. So discount rate is what? 10%. That means the PVF is going to be for year 1, 1 divided by 1.10, press equal to 1 divided by 1.10, 0.909. Year 2, 0.826. Year 3, 0.751 and so on. So ಇದರಲ್ಲಿ ಏನ್ ತಗೋಬೇಕು ಅಂತ ಕ್ವೆಶ್ಚನ್ ಇದೆ. ಪ್ರೆಸೆಂಟ್ ವ್ಯಾಲ್ಯೂ ಅಲ್ವಾ, ದಟ್ ಇಸ್ ವೈ. So year 0 means right now, no need to change anything. Already land value is given to be 2 lakhs. I will take it to be 2 lakhs. Building is given to be 3 lakhs at the end of year 1. So I will take the present value factor of year 1, that is 0.909, because I'm not investing 3 lakhs now, but after 1 year. So it will be 3 lakhs into 0.909. I hope everybody is able to understand. Good job. So 3 lakhs into 0.909 is given to be 2 lakhs 72,700. Again, I'm repeating, 3 lakhs is not happening now. After 1 year. So I'm taking 0.909. Okay. Machinery is happening how much? 10 lakhs at the end of year 2. Year 2 andre ಎಷ್ಟು ತಗಬೇಕು into 0.826. Into 0.826. So that means, can I say 8,26,000? Yes, I can say that. Okay. So now it is not happening. After 2 years, it is 10 lakhs. So present value of 10 lakhs is going to be 8,26,000. Okay. So next, end beginning of year 3 is the same as end of year 2. So it is going to be 5 lakhs into 0.826. 4,13,000. This is the present value of outflows, my dears. Let me know if any questions are there. Coming to 7,11,700. Thank you, dears. 7,11,700. So we have understood the present value of outflows. Now let us go to the present value of inflows. Now, present value of inflows, they have given all of this, that is sales, variable cost, fixed cost, depreciation, everything is given. But remember one thing very carefully, production starts from beginning of year 3 for 5 years. That means year 3, 4, 5 ಗೆ sales ಇದೆ, variable cost ಇರುತ್ತೆ, fixed cost, depreciation, everything is coming for year 3, 4 and 5. Okay. So now we will proceed. You're still writing? Please write. Please complete this quickly. Please complete this quickly. Okay. So now present value of inflows. Present value of inflows. So it is going to be particulars year 1, 2, 3, 4, and 5. Okay. In that, we will start with sales. I'm referring to the question. All of you also, please open the PDF and refer to the question. So now what we have is sales is 24 lakhs, 24 lakhs, and 24 lakhs. Is given to us. Ma'am, why you didn't take for year 1 and year 2? Because they have given in the question that the production starts from year 3 onwards only. That is why from year through 3 only I have taken the sales. In the question they have given. Okay. Minus variable cost. Variable cost is also given in the question, that is 8 lakhs. Now, if we want, we can write contribution, but we don't want all that because we want what? Cash flows. We are in capital budgeting. We are not in operational approach. So they are not in that chapter. So I don't have to do contribution. Directly, I will go to fixed cost. So first, fixed cost is given to me 5 lakhs. Okay. So now I will give a note here. All of you, please write down the note. Note fixed cost is assumed to be incurred from year 3. Why, ma'am, you wrote like this? Because fixed cost means what? Cost that is incurred irrespective of the level or volume of output. So even if the output is zero, maybe I will have to pay rent. Okay. Maybe I will have to pay certain fixed expenses, administrative expenses to take care of my assets. Maybe. So that is why I'm saying that. So, say for example, your production is not there. Can you say I will not pay rent? No, rent is a fixed cost. We have to pay it. That is why, to be on the safe side, I have given the note. So, a child can take fixed cost for first and second years also. Oh, here we have bought some machinery, some building, something and all. So, to maintain that, we may need a person for whom we are paying admin salary. That is a fixed cost. Maybe we need it in the first and second year also, but I have assumed it that way. Okay. Then we will subtract depreciation. Ma'am, why they have given depreciation separately? Because depreciation should be added back. CF80 in the beginning of the class, I explained to you. Those of you who came late, the beginning I had explained that depreciation is a non-cash item. So at the end, I will add back the depreciation. Ma'am, why are you subtracting depreciation? To calculate tax. Tax calculate ಮಾಡಬಿಟ್ಟು ಆಮೇಲೆ depreciation add back ಮಾಡೋಣ. So now depreciation is going to be 2 lakhs. So now we will get what? EBIT. We can call it as EBT also because there is no interest. Okay. So 24 minus 8 minus 5 minus 2. We'll get 9 lakhs everywhere. Now I will subtract tax at the rate of 33.33 percentage. So 9 lakhs into 33.33 percentages, yes, roughly 3 lakhs. So roughly 3 lakhs. Why we are doing all this, ma? NPV. NPV ge cash flows beko. That is why. DCF bekalva. So cash flows beko. DCF means discounted cash flows. So seventh point is going to be what? EAT. EAT is 6 lakhs. 6 lakhs. And 6 lakhs. Now we will add back depreciation, then we will get the cash flows. So depreciation again, if we add back, we will get how much? 2 lakhs. Then we will get what is called as cash flows. Okay. Sales minus cost will be profit. Profit minus tax, we'll get profit after tax. But depreciation is a non-cash item. So we will add it back to get cash flows. Okay. Discussed in the beginning of today's class. Correct. So now you all see, please watch. At the end of operational period, that is at the end of 5 years, at the end of operational period, fixed asset can be sold for 5 lakhs. That means, can I say scrap value is 5 lakhs? Yes. Scrap value is 5 lakhs. Okay. Next up, one more thing. This is the main thing why I am doing this problem itself. That is working capital. Working capital is 5 lakhs. Ma'am, what is the meaning of working capital? Working capital means we have working capital management itself, current assets minus current liabilities. Okay. In other words, can I say the cash that is required for day to day operations? Yes. So now I'm starting a business. I'm putting a working capital, okay, to purchase all my, you know, uh, inventory, raw material, all that, conversion cost, everything. And to pay my current liabilities, I'm investing 50,000 rupees. Working capital for day to day activities is 50,000. I will get it back from the business. No, I will earn profits, get back that money. Again, what I will do? Again, I will invest that 50,000 in the business itself. Like that, it is a continuous process, Alma. Once again, I'm saying 50,000 I will be putting in the business to buy raw materials. I will buy raw materials and then I will make sales. No, okay. So now I will make sales. And then what will happen? I will get money from my debtors. Okay. Again, that 50,000 I will be putting in the business only. Okay. So I will keep on putting my working capital in the business. I will get that money back. Again, I will put in the business. I'll get that money back. Again, I'll put in the business. So it is in a loop. Okay. Working capital. But now, in the last year, I will get 50,000 out of the business by making sales. Will I invest again? No. In the last year, I will not invest the working capital again. So again, I'm repeating working capital, current assets minus current liabilities, or else the capital required for day-to-day business. I'm investing 50,000. Again, I'll get back that 50,000 from the business. Again, I'll invest. Again, I'll get back that 50,000. Again, I'll invest because raw material will be purchased, sales will be made, raw material will be purchased, sales will be made. It is a continuous process. But in the last year, stop. I will get 50,000. I will not invest. So that is why we will get back working capital. So I will add that back working capital. So it is going to be in the last year. That is going to be how much? We all can see how much is the amount, ma'am? 5 lakhs. Ma'am, why you didn't take the PVF? At the end, we will take the PVF. After all the adjustments, we will take PVF. So that is 5 lakhs. Let me know if there are any questions because many of you asked the same question from exercise that working capital, why is it added back? I think now it is very clear. Then we will come back to point number 10. We should add back what? Again, scrap value. Already I told you about this 5 lakhs. This 5 lakhs. Last year, at the end of operation, fifth year, we are getting back 5 lakhs. So now we will calculate DCF. How to calculate DCF? First, we need cash flows. So cash flows is going to be 6 plus 2, that is 8 lakhs. 6 plus 2, again 8 lakhs. 6 plus 2 plus 5 plus 5, 18 lakhs. So I hope everybody got it. Now we will write the PVF. So always in case of working capital in the last year of operations, we'll plow it back. Okay. PVF is going to be at the rate of 10%. So 0.909, 0.826, 0.751, 0.683 and 0.621. So if you're not able to remember, no problem. Use your calculators. That's all. Now we will do what is called as DCF. So that is why I gave the note fixed cost. Okay, I gave the note. That is why. So 8 lakhs into 0.751. That is 6,800,000. Yes, thank you. 8 lakhs into 0.683 is 5,46,400. 18 lakhs into 0.621 is 11,17,800. So this was the big question asked previously. We have invested our time correctly because it may come, we don't know what will come in the exam, but it may come in the first question of FM. Okay. So now total of DCF, how much is it? 6,800,000 plus 546,400 plus 11,17,800. That is 5,46,400. I've written for one more zero extra. I'll just correct. 6,800,000 plus 5,46,400 plus 11,17,800. We are getting 22,65,000. 22,65,000. Okay. Now, what is the present value of outflows? 17,11,700. Present value of inflows is 22,65,000. So they have asked net present value. Net present value is present value of inflows minus present value of outflows. So I will use that. It will be easy for me to explain this problem. Present value of inflows minus present value of outflows. So present value of inflows is 22,65,000 minus present value of inflows is 17,11,700. Five lakh 53,300. So NPV is positive. So the conclusion will be NPV is positive. So accept the investment, accept the project. Conclusion. NPV is positive, or you can say greater than zero. So accept the project. So this is also done. So it was a very good problem for practice. So let us do this problem. An existing machine in Bipasha Limited can be sold today for rupees 1 lakh net. The cash flow after tax for the balance life of 4 years is 30,000 per annum. That means cash flow is the same every year. 30,000 per annum means every year it is 30,000. At the end of fourth year, the existing machine can be sold for 10,000. That means 20,000 is the scrap value. Scrap value. A new machine can replace the existing machine at a net cash outflow of 1,50,000 and will generate annual CFAT of 46,000. The scrap value at the end of useful life is going to be 25,000. Okay. If discount rate is 10%, find out whether the existing machine should be replaced with a new machine or not. This is also past exam question. So it is capable of being repeated. Okay. So now I'll open the questions here. Now we should find out the NPV of the current machine and the new machine. Then we should find out whether replacement is necessary or not based on the NPV. Okay. So now we will proceed. So the initial investment, this is existing. Okay, existing machine. Initial investment is going to be 1 lakh. Okay, all given in the question. Now year, because we need NPV, no, I'm going to write year cash flow, TVF at the rate of 10 percentage and DCF. Okay. So now we will write 1, 2, 3, and 4. Now, how are we supposed to do this? Cash flows is given to be same every year, 30,000, 30,000, 30,000, and scrap value is given for the existing machine. For the existing machine, scrap value is given to be how much? 20,000. So when the cash flows is same every year, you can use GT in your calculator, total of present value factor, everything we know. But if you think, ma'am, I'm getting confused there, do directly also, you'll get the same answer. No problem. That was taught to save you time. Anyway, here fourth year it is going to change. So directly if you do, or you do it in AF also, it will be the same. If you use annuity factor, then you have to use it only for 3 because last year it is changing. Last year separate again calculate ಮಾಡ್ಬೇಕು. Oh, so it is going to be, we all know 0.909, 0.826, 0.751 and 0.683. Now let us start doing the calculation. 30,000 into 0.909. 27,270. 20,000 into 0.826. 16,520. 30,000 into 0.751. 22,530. 50,000 into 0.683. That is 34,150. Now, if I do all this, how much is the total of DCF that we are getting? We are getting 1,47,000. Okay. Are we getting that? Should I check that again? Okay, let me check that. 30,000 into 0.826, is it? Oh, 2478. Okay, thank you, thank you, thank you, dear. 2478. Rest are out. So, what is the total that we are getting? Total is much. 27,270 plus 24,780 plus 22,530 plus 34,150. 1,08,730. So, NPV is equal to total of DCF minus initial investment. Here it is a very simple problem. So I can use this formula itself for NPV. Total of DCF is 1,07,000. 1,08,730 is the same as present value of inflows minus present value of outflows. Initial investment is 1 lakh. Already we wrote on top. So 8,730 is the NPV. Rupees 8,730. Now we'll find out the NPV of the replacement, then we will decide. We'll find out the NPV of the replacement, then we will decide. So please give the heading existing machine. Now, NPV of the replaced machine. NPV of the replaced machine. Suppose those of you who are doing along with me, you're not able to write within that time frame, means please take a photo of it. You can fill it up later. But understanding the concept is very much important. Now, so now we will proceed to again year cash flow, present value factor at the rate of 10 percentage as given in the question, and DCF. Here is 1, 2, 3, 4. Yes. Now it is going to be 46,000. 46,000 given in the question, second paragraph for the replaced machine. 46,000 plus the scrap value given in the second paragraph, second line is 25,000. Last year we will get the scrap value. Okay. 0.909, 0.826, 0.751, 0.683. 46,000 into 0.909. That is 41,814. 46,000 into 0.826. That is 37,996. 46,000 into 0.751. That is 34,546. 46,000 plus 25,000 into 0.683. It is 48,493. Just check everyone. Yes. Right here. One lakh 62,849. Okay. And what is the initial investment for the replaced machine? They are saying that it is going to be 1,50,000. So let us find out the NPV. NPV of the replaced machine, total of DCF minus initial investment. That is present value of inflows minus present value of outflows. 1,62,849 minus 1,50,000. 12,849. So now I will tell you how to write the conclusion. Students, let us see how to write the conclusion. Conclusion is going to be NPV of old and a new machine replaced. Old machine NPV was how much, dears? 8,730, right? And this is 12,849. 12,849 NPV is greater than 8,730 NPV. Acceptability criteria is greater than 0 means accept. But we have to choose whether to replace or not. So after replacing, we are getting higher NPV. So replace it. After replacing, we are getting higher NPV. So replace it. So replace. This is the conclusion. So now we have pretty much done this also. This is also past exam question. Okay. So conceptually, we are covering replacement concept also. We are covering working capital also. These are all, almost everything we are covering in today's class as far as capital budgeting is concerned, isn't it? Okay. So now we will take a quick break of 10 minutes. We will complete capital budgeting, start with cost of capital, then go for a lunch break. After lunch break, we'll come back and finish cost of capital and do capital structure also. Okay. So, chalo, everyone. So, I'll see you after 10 minutes.
Recording in progress.
So, this is also done. Now, excuse me. The project cost of 10,000 and the cash inflows in the first, second, third, fourth years respectively are given here. Find out the time adjusted rate of return. So the time adjusted return is nothing but IRR because it considers time value of money into consideration. Okay. It takes time value of money into consideration. That is why it is called time adjusted rate of return method. Okay. So those of you who do not know, you please write down TAR, time adjusted rate is nothing but internal rate of return. It may come as a theory also. Sure. So now, how are we supposed to do the IRR calculation? So IRR is purely formula based. It is based on interpolation. Okay. So IRR, the formula is RL plus V1 minus V0 divided by V1 minus V2 into RH minus RL, where RL is equal to lower rate. RH is equal to higher rate. You all know that IRR is calculated by assuming two rate of returns. Okay, we have to assume two. How to assume, I will tell, but exactly we can't assume the same. If I assume 10 and 20, you may assume 15 and 20. So it will not be exactly the same, but our final answer should be around the same number. Okay, but andazagi how to assume also, I'll let you know. V0 is equal to initial investment. V1 is equal to total of DCF of RL. For lower rate of return, how much is the DCF? V2 is equal to total of DCF for R2, RH. So what is the present value of inflows for higher rate of return? Now you will be able to understand in a few minutes from now how to calculate this. Some were struggling, not everyone, some were struggling. So I thought of doing it in the class. Okay. Shall we begin? Yes. So it is going to be the cash flows are given as how much? 2,000, 3,000, 5,000, and 6,000. Okay. So total is how much? 5 plus 5, 10, 16,000. This is the total cash flows. Okay. What is the initial investment? Initial investment is given to be 10,000 in the first line of the question. Okay. Now, how much is the years, number of years life is given to be 4 years. Now, let us calculate the annuity factor. Ma'am, what is annuity factor? Annuity factor, you all remember, it is the total of present values. So, let us find out 10,000 divided by 4. It is going to be 2,500. All right. Now, how to find out the annuity factor? One more easy way, I'll say, because it's not a regular class. Easy way, let me tell you. So we all know that average cash flows is going to be how much? 16,000 divided by 4 years. Totally, we are getting 16,000 divided by 4 years is going to be how much? 4,000. Yeah, correct. 4,000 is the average cash flows. So that means 10,000 I need. Out of that, every year I'm getting 4,000. 10,000 totally I need. Every year I'm getting 4,000 means 10,000 divided by 4,000. That is going to be 2.5. Correct. 2.5 years. So the annuity factor is around 2.5. Okay. So again, I'm saying how to what I'm doing is we need one RL and one RH. No, how to find this out? Okay, that only I'm explaining all this. First, average cash flows, total cash flows divided by number of years, just like total marks divided by number of subjects. Same way, you will find out the average cash flows. Then what we should do is then we should do this. That is initial investment divided by average cash flows. You will get one number. That is the rough annuity factor that I'm looking for. Okay. Let me find out the annuity factor at 10 percentage for 4 years. How I should do? 0.909 first year, second year 0.826, 0.783, 0.683, 0.751. Sorry, correct. 0.751. Okay. Now, when we do this, what is our annuity factor? We all know annuity factor is totally present value factors. So 0.909 plus 0.826 plus 0.751 plus 0.683. How much are we getting? 3.169. Okay. So now, but I want 2.5. So I'm finding a rate wherein the annuity factor will be close to 2.5. Okay. So any two rates you can assume and then you can do IRR. But in one rate, I need positive NPV. One rate, we need negative NPV. Again, I'm saying RL and RH. Okay. We need to assume two rates of return. Say, for example, one is 10 and one is 20. In one rate, I should get less than, the NPV should be less than zero. In another one, it should be NPV should be greater than zero. Like that, we should choose two rates. Like that, we should choose two rates. Okay. Okay. Now, what is this IRR? IRR is the rate at which NPV is equal to zero. I am finding out the exact rate at which NPV is zero. That is why I'm taking one positive NPV and one negative NPV. So now, annuity factor at 20 percentage, let me do. Okay, so directly I'll do in the calc. 1 divided by 1.20 equal to, I will press 4 times and I will press GT. Okay, in this calculator GT is not there. Okay, so 1 divided by 1.2 equal to memory plus, equal to memory plus, equal to memory plus, equal to memory plus. 2.58. Achha. 2.58 is close to 2.50. So I will choose 20 percentage. Annuity factor at the rate of 25 percentage, let me do. 1 divided by 1.25. That is going to be equal to memory plus, equal to memory plus, equal to memory plus, equal to memory plus 2.36. So I'm getting one more than 2.5, one less than 2.5. That means one positive NPV, one negative NPV. So I can go ahead for IRR. Ma'am, I can choose 10% and 25%. Yes, you can. But if the rates are too far away, your answer will become deviated, distorted. So that is why choose two rates which are little bit close to each other. Okay. So now our rates that we have chosen are 20% and 25%. Anyone is having any doubt as to how to choose it? Calculate the calculate the average cash flows. Initial investment divided by average cash flows, you will get the annuity factor. You should find out the annuity factor, which is one above and one below. How to find out annuity factor? Annuity factor is nothing but total of present value factors for 4 years. In this question, it is 4 years. Okay. I hope it is very clear for everyone. Okay. Now we will start with so we will do the DCF calculation. V1, we all know the formula. So for that, I will take at the rate of what? 20 percentage. So we have year, then we have cash flow, then we have PVF at the rate of 20 percentage, and we have DCF. So quickly, let us do the calculations. Come on, students. It will be 1, 2, 3, 4, and cash flows were 2, 3, 5, and 6. 2, 3, 5, and 6. It is not a past exam question, but just to clear your doubts, I'm doing this problem. So 1 divided by 1.20, that is 0.833. 0.694. 0.578, 0.48, 2000 into 0.833, we get 167. 3000 into 0.694, we get 2082. 5000 into 0.578, we get 2890. 6000 into 0.482, we get 2892. Okay. Now, when we add everything, yes, dears, 2082 and 1667, we get 9531. 9531, we all know it is less than 10,000. 10,000 is the initial investment, Alma. 10,000 is the initial investment. It is less than this. Okay. Now, let me explain further. Okay. Normally, I said 20% and 25%. But if I increase the depreciation rate, 20%, 25% is what? Depreciation of money. If I increase the depreciation rate, the value will come down, no? Yes, ma. So, for example, you all see, if the depreciation rate is 10 percentage, then 10,000 is the value of asset. Okay, 10,000 is the value of asset, means depreciation will be 1,000. If the depreciation is 20 percentage, then the depreciation will be 2,000 into 10, 2,000, that is how 10,000 into 20 percentage. So the value of asset here, it will be 9,000. Here it will be 8,000. No? So if I increase the rate from 20 to 25, the NPV will go down even further. So I want one positive NPV, one negative NPV. Here, what is the NPV? That is 10,000 minus 9531. How much is that? Yes, ma'am. Minus 469. We are getting a negative NPV. So now I will increase the rate. Okay. So that I will decrease the rate. I'm so sorry. I will decrease the rate so that we are able to get a positive NPV. Ma'am, then why you taught us 20 and 25% means how to actually go about the rates in case of, quick calculations. So here it is logical. Already I'm getting a negative NPV. So let me take rate is equal to, let us take, say, for example, 18 percentage. Okay, 18%. You can take 15% also, no problem. Year, then cash flow, then PVF at 18 percentage, and then we have DCF. So year 1, 2, 3, and 4. Okay. So now, what are the amounts? It is 2,000, 3,000, 5,000, and 6,000. 2,000, 3,000, 5,000, and 6,000. PVF will be 1 divided by 1.18, 0.847, 0.718, 0.608, 0.515. So when we do like this, how is it going? 2,000 into 0.847. How much is that? 1694. Right, dears. 3,000 into 0.718. That is 2154. 5,000 into 0.608. That is 3040. 6,000 into 0.515. That is 3090. Now, when we do the total of all this, let us see how much we get. 3040 plus 2154 plus 1694. We are getting, oh my God, again 9978 we are getting. That is the problem about this. 1694, 2154, 3040, 3090, 2154, and 1694. We are getting 9978. See, again 9978 means again we are getting NPV which is lesser than 0. I need NPV which is greater than 0, correct? So I will change the rate to, say, for example, 16 percentage. So it is a assumption. So assumptions have to change based on the values that we get. This is how it happens. So it is very easy for us to just take two rates which are given in our textbook, but we can't do that. No, how you will think in the exam? 1 divided by 1.16, you get 0.862, 0.743, 0.641. Until you do, you won't know what NPV you will get also. So 0.552. So it is an assumption based. That is why we'll have to keep changing. So 2000 into 0.862, that is 1724. 3000 into 0.743, that is 2229. 5000 into 0.641, that is 3205. 6000 into 0.552, that is 3312. Now we will do the total. 1724 plus 2229 plus 3205 plus 3312. We'll get 10,470. Okay. Now we are getting a positive NPV because 10,470 is bigger than, yes, 10,000 initial investment. Right. So it is greater than 10,000. Now you see 9531 is less than 10,000. 10,470 is greater than this. So now we will proceed. How to do the IRR? RL, RH. Okay. Then we will write V1 and V2. RL is what? 16%. RH is what? What did we take? 20. Yeah? Yes, 20 percentage. Correct. 9531. 20%. It is 10,470. Okay. With this, let us see how to go about. IRR is going to be RL plus V1 minus V0 divided by V1 minus V2 into RH minus RL. So now how to do this? Already this formula we have seen. So IRR is equal to RL. What is the lower rate of return? 16%. So always remember, one value should be more than 10,000, one value should be less than 10,000. 10,000 is the initial investment. One is more than initial investment, one is less than initial investment. Plus V1 is what? 9531 minus 10,000. That is V0 is, yes, 10,000 initial investment. V1 is what? V1 is going to be how much, dears? 9531 minus 10,470. Yes. So 10,000 minus 10,531 and then 10,470 minus 9,531. Into 20% minus 16%. So when you do this fraction alone, when you do this part alone, no, you will get in the calculator, I just now did, I'm getting 0.499. So I will take it as 0.50. Okay. So how do I solve it? So 16% plus 0.50 into, when you solve this part alone, you will get 0.50 into 20% minus 16% is 4%. So 16% plus 2% will be 18%. This is the IRR. So this is how we should do the IRR calculation. That also we have completed now. So now we will do the other things also in the checklist. We will complete everything. So IRR is also done. Now, I will just explain the concept of certainty of cash flows or probability, standard deviation, coefficient of variation, then the entire checklist, we have done everything. It is a very good revision. Yes. So now we will proceed to Standard deviation. See, it is a measure of risk as far as our FM is concerned. No, it is a measure of risk. Why? Average profits is nothing but what we call it as mean. From the mean only, we'll calculate standard deviation. Average agi, suppose say for example, nange 10,000 profit barbeku. Suppose I'm getting 12,000 or I'm getting 9,000 means there is deviation. So, ಎಷ್ಟು deviation ಇದೆ ಅಂಡ್ ಪ್ರಾಬಬಿಲಿಟಿನೂ ತಗೊಂಡ್ಬಿಟ್ಟು ಡಿವಿಯೇಷನ್ ಕ್ಯಾಲ್ಕುಲೇಟ್ ಮಾಡ್ತಾ ಇದ್ದೀನಿ. ತುಂಬಾ ಡಿವಿಯೇಷನ್ ಇದ್ರೆ ತುಂಬಾ ರಿಸ್ಕ್ ಇದೆ, ಕಡಿಮೆ ಡಿವಿಯೇಷನ್ ಅಂದ್ರೆ ರಿಸ್ಕ್ ಕಡಿಮೆ ಇದೆ. ಆಲ್ ರೈಟ್. ಸೊ ನೌ what will happen is, so based on that you will take the mean, you will calculate the mean. So then you will calculate the deviation. As I told you, 9,000 means it is lesser than the way lesser than your average mean. Okay. And 12,000 means it is more than your mean. So accordingly, you will calculate what is called as probability multiplied by deviation square. And then that square root will give you standard deviation. It is a very, whatever statistics, whatever we have learned, very similar to that. Calculate the mean, then calculate the deviation, do deviation square, multiplied by probability, do the square root. This is how you will do. Higher the standard deviation, higher the risk. Higher the standard deviation, higher the risk. Okay, so one problem is there in study material we have done in regular class. Even if you have not attended regular class, you can still aram se do it. It is a very easy concept based on what I have explained now. So now we will proceed to, suppose they are not saying you calculate standard deviation. They have given probability. They are telling assess the risk of the project, means you have to calculate standard deviation. Okay. So now let us do coefficient of variation. Coefficient of variation, when we will do? When initial investment of two projects are different, or when the lives are different, no, that time standard deviation I can't use. For measuring risk, this is also a measure of risk. Again, I'm saying, like standard deviation, coefficient of variation is also measure of risk. But when the initial investment of two projects are different, okay, or when the lives of the two projects are different, just like instead of NPV, we used to do profitability index, like that, when the initial investment of two projects, that is one project is 50,000, another project is 60,000. In that case, or one project life is 3 years, another project life is 2 years, means in such cases, we will use coefficient of variation instead of standard deviation. It is a replacement of standard deviation. What is the formula for coefficient of variation? Standard deviation divided by mean into 100. Standard deviation divided by mean into 100. Like that, we should calculate. It is quite simple. Okay, this is also a measure of risk. Again, higher the coefficient of variation, higher the risk. Higher the coefficient of variation, higher the risk. So this is also done. Very simple. So standard deviation, coefficient of variation also explained. So this also one problem we have. Go through, please understand standard deviation and for basic risk. When life of the project or initial investment, that is the cost of the projects are different, then coefficient of variation, both are measures of risk. Please do the problems in your study material. It is very simple. Next is going to be else I wanted to explain was coefficient. Certainty coefficients. Certainty coefficients means now 10,000 into certainty coefficient is they will give you 0.9 or 90%. What is the meaning of that? I'm 90% sure that I will get 10,000. That means I should take 9,000 only to be on the safer side, because you're only 90% sure that you will get 10,000. 10,000 is what? Mark cash flow. Okay, 90% is coefficient. Okay, certainty coefficient given in the question. It will be given in the question. Then your actual cash flow will be 9,000. Then you will have to do PVF and then DCF and all based on this. Okay. So 10,000 into 90%. Same thing, concept with probability also. Okay. So if probability or certainty coefficient is given to you, first you find that out. Based on that, you will calculate DCF. So please go through this problem also that I have mentioned in the study material. With whatever concept I explained now, easily you can tick off the checklist. So this is also done. This is also done. So everything in the checklist we have done. So nothing is left. It was a good revision. Okay, good cooperation, good revision for capital budgeting. Now we will take a lunch break and then we will join for cost of capital and capital structure. So online students will take a lunch break of half an hour and then I will meet. Yes, students. So let's start the discussions. So capital budgeting is completely over. Now we will start with cost of capital. Cost of capital means what? Now, I can raise capital as a company through many ways like debt, preference shares, equity shares, like that, multiple ways I can raise the funds. But it is a cost to the company, Alva. Yes, it is a cost to the company because I have to pay interest for debenture holders, I have to pay dividend for preference shareholders, I have to pay dividend for equity shareholders also. So that is why, is like this. So now we will proceed, what I wanted to say is that is why we have cost of debt, cost of preference shares, and cost of equity shares. So, like that, we have the cost for each and every component of capital. So, now we will proceed with cost of debt. It is equal to interest after tax divided by net proceeds into 100 if the debt is irredeemable. Debt is irredeemable. So obviously in the regular class I would have explained this in a lot of detail and multiple examples with the help of how to remember this, but now I can go a little bit fast only because we have to cover multiple things. So net proceeds means what? Net proceeds means face value or the issue price minus the brokerage or the discount on issue. That is what is the net proceeds. Okay, again I'm saying net proceeds is equal to issue price, that is in if you have face value minus brokerage minus discount on issue. Okay, minus cost of issue also. Okay, considering it as a part of brokerage, I've just told this. Okay, then cost of debt. One more thing, if net proceeds is not given, if it is a secondary issue, then market price per share can also be taken. If this is not given, this can be taken. Okay. Cost of debt, in case a debt is redeemable, then it is going to be interest after tax plus redeemable value minus net proceeds divided by n, the whole divided by redeemable value plus net proceeds divided by n. Okay. What is redeemable value? It is going to be face value plus premium on redemption. Redemption means what? Repayment. If I'm repaying at a premium means I'm paying more money. Redemption value. So this is the value that I repay. Say for example, I'm repaying 110, but I am getting only 100. Okay. So that means 10 rupees is my loss. So again, I'm saying I'm collecting 100 from you, but when I'm repaying, I'm paying 10 rupees extra apart from interest. Okay. That means this 10 rupees loss is not attributable for 1 year, but across the life of the debentures. That is why divided by N. All right. Divided by average investment. Okay. Now we will proceed to here one more thing. If a premium on issue is given, here we will add plus premium on issue. So you have to find out whether the discount is on issue or discount is on redemption. Okay. Mostly there is no discount on redemption. Yes, nobody will accept lesser value. Premium, if it is given, premium on issue or premium on redemption has to be really paid attention into the question. Okay. So this is the formula when it is redeemable, irredeemable. This is the formula when it is redeemable. Okay. All are after tax. All are after tax. Because WAC calculation, that is weighted average cost of capital Koskara, we are learning all this. WAC, weighted average cost of capital, is after tax. Okay. So now it is going to be cost of preference shares. Cost of preference shares when it is irredeemable. Irredeemable means what? The redemption date is not given. Okay. When we are going to repay, redemption means repayment. When we are going to repay is not known to us, then it is irredeemable. The formula is preference dividend divided by net proceeds. If net proceeds is not given, market price. Okay. Cost of preference shares when it is redeemable. It is going to be preference dividend plus redeemable value minus net proceeds divided by n, the whole divided by redeemable value plus net proceeds divided by 2. Very similar to debt. Not same, but similar to debt. One thing we should understand is debt interest is an allowable expense for tax purpose, but preference dividend or any dividend is not an allowable expense for tax purpose. Again, I'm repeating slowly. As per Income Tax Act, interest on debt or debentures or any interest is an allowable expense, but dividend is not an allowable expense. Sure. Next up, cost of equity. DPS divided by MPS or EPS divided by MPS or DPS divided by MPS plus G, where growth rate of stable dividend is given. Stable growth rate in dividend is given. So three formulas are there. If the stable growth rate and dividend is given in the question, you will choose this. Okay. You can choose whichever based on what is given in the question. Okay. Then cost of retained earnings is equal to, please listen everyone, if nothing else is given in the question, ma'am, no other information is given in the question, means KRE is equal to KE. Cost of retained earnings is equal to earnings. Cost of equity. Cost of equity. Why, ma'am? Because retained earnings belongs to whom? Equity shareholders. That is why cost of retained earnings is equal to cost of equity. Okay. 1 minute, yes. Now we will proceed to KRE is equal to what? If information about shareholders tax as well as information about capital gains is given, then what we should do? All of you, please listen. It is going to be DPS into after shareholder tax, after brokerage. So we should take DPS after shareholder tax and after brokerage, if any, divided by MPS after capital gain tax. Most of you who have attended DT class, you all know that when we are selling the shares, we will get capital gains. And when we are getting dividend, it is subject to income from other sources. So you will have income tax on that. So based on that concept only, shareholders tax on the top, that is numerator for DPS, dividend per share, and for MPS, capital gains tax. Understood, everyone? So these are the formulas. Quickly, we have gone through. Okay, so now we will proceed with this chapter. So this chapter is a very easy chapter, but first, because we have come back after the break, I would like to do something which is like a past exam question, then we will start doing the other problems. Okay. Yes. This is a question which was asked in the past exam, recent past exam within about 3 years. So this was asked in the first 20 mark question, compulsory question it was asked. So I'm doing this first. Magma Limited is a manufacturing industry which has a mix of equity and debt to finance the business. Just give me 1 minute. Okay. The company is growing at a considerable rate, prompting the management to go for expansion. The company is considering various alternatives to raise the funds. The capital structure is given. What is the capital structure? They have debentures, first issue. They have another set of debentures, second issue. One is 12%, another one is 13 percentage. Okay. 10% cumulative preference shares. Okay. Then equity shares, retained earnings, everything is given. Okay. Next, equity shares sold in the market at rupees 25 per share. Okay. So that means MPS is 25. Okay. Company contemplating declaration of dividend rupees 3 per share at the end of the financial year. Okay. That means DPS is going to be uh, 3. But one thing I would like to tell you all, see, DPS is 3. One more thing is, we have done dividend chapter also, where we used to learn, P0 is equal to D1 plus P1 divided by 1 plus KE. Formula, we have learned this. Okay. So again, I'm repeating. In dividend chapter, model, which we will be doing tomorrow, we have learned P0 is equal to D1 plus P1 divided by 1 plus KE. Now, D1 andre ಏನು? Okay. D1 means dividend at the end of first year. Dividend at the end of year 1. Dividend at the end of year 1. Right. D0 means dividend right now. Dividend right now. Sometimes they will give now the latest dividend. Latest dividend is 3, and next year it will grow by 5%. So 3 into 105% ಮಾಡಬೇಕು to find out what D1. But if D0 is given to be 3, again I'm saying, suppose D0, right now the dividend that is declared, the latest dividend is 3 means 5% is the growth in dividend, means D1 will be what? 3 into 105 percentage. So please be very careful about reading the question. Here, this model, now I'm not going to use, but for your understanding, I'm saying all this. So dividend at the end of the year, that means D1 is going to be 3. Okay. The company pays all the earnings as dividend. Okay. Rupees 100 per share, 100 per debenture, uh, redeemable at par with 2% flotation cost, 8 years maturity. That means the life of the debentures is given. That means it is redeemable debentures. That means it is redeemable debentures. Market price of the debenture is given to be 120. Second issue of debentures is 100, redeemable after 5 years, currently selling at 90 per debenture. Currently selling at 90 per debenture. Okay. Then 100 per preference share, redeemable at par, 3% flotation cost, 10 years maturity. Okay. Market price per preference share is rupees 108. Okay. So that means what? Now, second issue also, same thing. They have given the life, and current selling price is going to be 90. Yes, ma'am. Ma'am, why current selling price and all is given? They have given me about flotation cost, means I will take net proceeds. Correct. But maybe the weights are based on market value. Okay, so first we will aram say read the question, then we will see how to attack it. Now, then They have given the same thing about preference share also. Tax applicable, that is the corporate tax rate is 30%. Now they have given shareholders tax rate and capital gain tax rate. We all know that we will be using it in cost of retained earnings. If the last point is not given, KE is equal to KRE. Cost of equity is equal to cost of retained earnings ಅಂತ ತಗೋಬಹುದು. The CFO of the company is keen in understanding the cost of capital. Accordingly, you are appointed to compute the following tasks. Find out the weighted average cost of capital using book value weights, market value weights. Further, the company also intends to know the market price of the equity shares at the end of the current year using approach, along with the assumptions of the theory. Assumptions of the theory is clearly already discussed in the regular class and already given in the theory material that we have, so that you will have to manage on your own. Otherwise, everything else I will be doing. Assuming the company has a sales of 20 lakhs, variable cost is this, fixed cost is this, calculate operating leverage, financial leverage, and combined leverage. Of course, this is from the chapter capital structure. Okay, up to this, it is going to be cost of capital. Okay, so now we shall proceed and see how we need to do. Okay, so first of all, cost of WACC. So what are they asking for? Weighted average cost of capital. What is the format for calculating WACC? WACC is going to be nothing but we will have capital structure. Capital structure nalli debt barbodu, preference shares barbodu, equity shares barbodu, retained earnings barbodu. Admela, what else we should choose? We should choose the proportion. Proportion will be based on the total. Okay. Then we will have cost, percentage, whatever is the percentage. Then finally, what we calculate will be the WACC. Okay. This is the format. Those of you who are a little bit new to it, you can write it down and we will be checking out how to do. Okay. So basically, it is nothing but cost of debt separately the company has, cost of equity separately the company has, same way for preference shares, retained earnings, everything. Now, ma'am, for retained earnings, how do we have cost? I have to grow that, I have to keep that cost inside the company. I have to keep that funds inside the company. So for that, I will incur a cost. No, that is what is cost of retained earnings. Okay. In other words, how you can remember is it also belongs to equity shareholders. That means there is a cost to that also. Okay. So now, instead of finding out separate cost, what is the average cost? That is what we are going to do in this WACC, weighted average cost of capital. So separate agi cost heng ಮಾಡಬೇಕು ಅಂತ ಗೊತ್ತು ನಮಗೆ from the formulas. How to do WACC? That also we are going to now find. Okay. So now we shall start with the problem. So for WACC calculation, especially for such big problems, first we should calculate the specific cost. Specific cost andre K D separately, KE separately, cost of debt separately, cost of equity separately. Like that we should calculate. So first, based on what is given in the question, KD stands for cost of debt. First issue I'm going to do. It is going to be, because the redemption is given, you all can see in the question. I will show it to you. They have said that the first issue debentures are redeemed at 8 years maturity. They have given the life of the debentures. That means it is redeemable. Otherwise, it is irredeemable. If they give the life of the debentures, it is redeemable. Otherwise, it is irredeemable. Okay. So it is going to be interest after tax plus redeemable value minus net proceeds divided by N, the whole divided by redeemable value plus net proceeds divided by 2. Okay. Now let us see what is the interest. I'll delete these markings so that it is clear for you while now explaining. Now, how are we supposed to do? Now they have said the flotation cost is how much? 2%. Okay. Now, interest is going to be calculated at the rate of 12%. We all know that 12% debentures means, what is the meaning of it? Interest is 12 percentage. 13% debentures means interest is 13 percentage. Okay. After tax, we are talking about company tax rate, not shareholder tax rate, not capital gain tax rate. Company tax rate or corporate tax rate, which is 30 percentage. So it is going to be interest 12 percentage into, we used to write interest after tax, no? So I will do one thing. Can you all see this? Interest after tax. How to do that? Interest after tax is equal to 12% into 70 percentage. Ma'am, why? If tax rate is 30 percentage, after tax rate is going to be 70 percentage. Like that we can say. Because of that only, I took 70 percentage after tax rate. So 12 into 70%, we will get 8.4 percentage. So interest after tax is how much? 8.4%. Okay. We will keep it as it is. Now, let us calculate RV, redeemable value. Now, please listen to me, everyone. Redeemable value, they have said rupees 100 redeemable at par. At par means face value. So 100 rupees is the face value. Redemption is also at 100. So which means it is going to be 100. Net proceeds is going to be face value minus issue price or brokerage, issue cost or brokerage. So 100 minus 2 percentage of 100, that is going to be 2. So 100 minus 2, that is going to be 98. I hope everybody understood. Then N, just now I showed you, once again I will show. N is going to be how much? 8 years maturity. We are talking about first issue debentures. 8 years maturity. So 8 years. N is equal to 8 years. Okay. So this much all of us have understood. Now let us proceed. So now we know that interest after tax is how much? 8.4 percentage. So 8.4%. How did we get? 12 into 70%. Some of you would have learned it as 12 into 1 minus 0.3. That is only we have written it as 70%. Okay, like that also you can. Plus redeemable value. Redeemable value, we saw it is 100. Net proceeds is 98. N is 8. Okay. Redeemable value is 100 at par. Redeemed at par, no? So redeemed at face value 100. Redemption means repayment. Net proceeds is 98 divided by 8. The whole divided by 100 plus 98 divided by 2. Okay. So now how can we do it? Let us understand this now. So it is going to be 100 minus 98 divided by 8. We get 0.25 there. Okay. So then in the denominator, we get 99. So 8.65 divided by 99, we get 0.088. So KD, I can tell it to be 8.7% or 8.8%. 0.087 we got. So we can say 8.7 or 8. Okay. Hello, students, we have done this. Now we will proceed to KD for first issue is over. KD for first issue is over. Now KD for second issue. KD for second issue. Again, for second issue also, they have talked about what? They have talked about the maturity. That is, can you all see? That is redeemable after 5 years. Okay. So that means we will again say it is redeemed at par because nothing else is given in the question. Suppose premium on redemption they have given means redeemable value is equal to face value plus premium on redemption as discussed just now. Okay. So preference, very sorry, interest after tax interest after tax plus redeemable value minus net proceeds divided by n, the whole divided by redeemable value plus net proceeds divided by 2. Now, how are we supposed to do this? KD, the second issue, yeah, what is the cost of debt? Yeah, the cost of debt is given to be 13 percentage. I hope everybody can see that is 13 percentage. So it is going to be 13 into after tax rate. Tax rate is 70 means after tax rate will be 30. Here tax rate is 30. So after tax rate will be 70. So once again, I'm saying, suppose if tax rate, this is just an example, okay? Tax rate is 60%, sorry, 40% means after tax rate will be what? 60%. Okay. So same way here tax, this is only example. Tax rate is given to be 30%. So that means after tax rate is 70% plus RV redeemed at par. Net proceeds. They have not said anything about cost of issue or anything. So net proceeds is also 100 divided by 5. Life is 5. RV, that is 100 plus net proceeds is how much? Again 100 divided by 2 because there is no cost of issue also. Very simple it is. So 13 into 70%, 9.1 percentage plus 0 divided by 100. So 9.1 percentage. That is the cost of debt for the second issue. This is the cost of debt for the second issue. So this is done. This is done. Now let us go to this. 3% flotation cost is there. 10 years is N. Market price later on we'll take. Redeemed at par. Redeemed at par. Okay, ma'am. So KPS. KPS. That means cost of preference shares is going to be preference dividend plus redeemable value minus net proceeds divided by N, the whole divided by redeemable value plus net proceeds divided by 2. Okay. Preference dividend is going to be what they have given in the question. That is 10 percentage. 10 percentage preference shares means what? 10 percentage is the dividend. Okay. So it is going to be what? And always dividend or interest will be applied only on face value. The percentage will be applied only on face value. Okay. Preference dividend is going to be what? 100 into 10 percentage. That is 100 face value. No? Okay. We will not do any after tax and all because dividend is not an allowable expense. Already we discussed the formula. Redeemable value. It is redeemed at par 100. Flotation cost is 3 percentage. So 100 face value minus issue cost. Issue cost is how much? 3. 3 percentage of 100. So it is going to be 97. That is how we got 97. Divided by N. What is the N that is given? 10 years. The whole divided by 100 plus 97 divided by 2. So let us simplify this. Is 10.46. 10.46 percentage. KPS is also over. Let us do KE, KRE, that is cost of equity and cost of retained earnings. Then all our basic work will be done. Quickly we can answer. Okay. This is a 20-mark question asked in the recent exams. Okay. So now this is also done. Now we will go to this. They have given MPS is 25 and 3 rupees is the D1. D1 is 3 rupees. Okay. So here itself I will do KE. I already told you there are 3 formulas. So out of that I will use DPS divided by MPS. Ma'am, they have given dividend. Okay. They didn't give growth rate. So I'm not taking G. Okay. So DPS, here we mean D1 only. D1. That is 3 divided by, sorry, 3 divided by 25 as per the first line of the question. So 3 divided by 25, that is 12 percentage. So ma'am, why you took D1? Why? Because you remember KE is equal to D1 divided by P0 plus G. This is the formula that we used to do in dividend chapter also. So those of you who have forgotten, you can write this. D1 means dividend at the end of first year. D0 means dividend right now. Okay. KRE. KRE is equal to what term? We all know it is DPS after brokerage, after shareholder tax divided by MPS after capital gain tax. Shareholders tax is 25%. Capital gains taxes, sorry, shareholders tax is 25%. Capital gain tax is 20%. So let us see how to do this. KRE is equal to DPS. How much is the DPS? 3. After shareholder tax, what is the shareholders tax? It is given to be 25%. So that means after tax will be 75 percentage. Again, I'm saying tax rate is 25 means after tax rate will be 75 percentage divided by MPS. MPS is 25 into tax, capital gain tax rate is 20%. So after tax will be how much? 80 percentage. So 11.25 percentage. This is the KRE, cost of retained earnings. Now we have everything. Let us start doing. Now they have asked us for what? WACC as per book value and market value. So now please listen. We have particulars. We have book value. Then we will have proportion. Directly, if you want, you can write proportion, but for easy understanding, I've written book value also. Then specific cost. Then we will have WACC. So now we will start with first issue debentures. Whatever is given in the question. Okay. They have given the question from equity shares. So even I will write in the order of the question so that I'm not missing any item. Equity shares. I'll show you what I'm writing in order. Okay, we'll go in the order of the table. I'm so sorry. We'll go in the order of the table. So we have first issue debentures, second issue debentures, then we have preference shares, then we have what? We have equity shares, and then we have retained earnings. So 3 lakhs, 2 lakhs, 2.5 lakhs. 3 lakhs, 2 lakhs, 2.5 lakhs, then 6 lakhs and 1 lakh 50,000. 6 lakhs and 1 lakh 50,000. Now we will do the total of everything. I think that is also given in the question. Yes, 15 lakhs. Yes. So 15 lakhs. So the proportion is going to be 3 divided by 15, that is 20 percentage. Yes, super. 13.33 percentage. Yes, that is what I was also thinking, whether we can write in decimals. Okay. So you can write in percentage or you can write in decimals. It doesn't matter because some of you are getting confused. We can write in decimals to avoid that confusion. So 0.20, 0.133. Okay. Then what is the thing for 1.167? Okay. 0.400 and zero 0.1. Okay. So if you do a total, obviously you should get 1. That is all for your cross checking. Specific cost. Now, first issue get how much was the specific cost? You all remember we got 8.7%. Second issue we got 9.1%. 8.7. Again, I will write it as 0.8, 0.087, 0.091. And then KPS, we got 10.46, so 0.1046. Cost of equity was 12%, and this was retained earnings was 11.25. So decimals, many of you found to be easy. So I have changed the percentage and made it decimals. That's all. So it is going to be 0.12 and 0.1125. Okay. Now we will do the rest. 0.2 into point, we will get 0.0174. Yes, it is going to be 0.1210. Okay. Then 0.1046 into 0.167. We get 0.0174. Okay. Then, yes, this is 0.0120. Okay. So then 0.400 into 0.12. We'll get 0.048 and 0.1125 into 0.10. We'll get 0.01125. Yes. All of you, please total this and tell me how much are we getting? 10.63. All right. So 10.63 percentage. You can write it in decimals also, not a problem. So 10.63 percentage. You have to give the heading that it is VAT as per book weights. This is only point number 1 that they have asked. Okay. All right, students. Now let us see. Book value weights is done. Now we will do market value weights. That also let us do. Okay. So I think everybody is comfortable. So far, what did we do? KD, KPS, KD itself, we had first issue and second issue. KPS means it is nothing but cost of preference shares, cost of equity, cost of retained earnings, everything we calculated separately. We took the proportion of the book weights and we calculated the average cost of capitals. Okay. This was book value. Now, what will change here, you know? It will change based on market values. What is it? It is market value. In market value, of course, the proportion will also change and the market values will also change. So let us see how to do that. Okay. So all of you will pay full attention here because it's a little bit important to discuss this. Okay. Now, let us discuss the face value of everything. Okay. Let us discuss the face value. They have given 100 per debenture is the face value for both the debentures. So for this also 100 rupees is the face value. Ma'am, why are you writing this? To find out the number of debentures. To find out the number of debentures. Then for preference shares also, we have been given 100 rupees is the face value. So for this also 100 is the face value. For equity, they have themselves given that the share is rupees 10 per share face value. So now to find out number of equity shares, fine. Now 3 lakh divided by 100. That means 3000 shares. Sorry, 3000 debentures. 3000 debentures. 2 lakh divided by 100. So 2000 debentures. 2,50,000 divided by 100, 2,500 preference shares, 6 lakhs divided by 10, 60,000 equity shares. Ma'am, why did you find out the number of debentures or number of shares means? We have to multiply it with market price. We have to multiply it with market price. How much is the market price? For the first debenture, it is 120. Second debenture, it is 90. So let me go and write 120 and 90. Then only number of debentures into market value per debenture will get market value of all debentures. This market value of preference shares is 108. Market value of equities is 25. So 108 and 25. Okay, everything is given in the question. Okay. Ma'am, what about retained earnings? There is no market value for retained earnings because it is retained inside the company. There is no scope for market value. It is retained earnings means what? It is kept inside the company. So how can you have market value? It will be the same as book value, market value for retained earnings. So how do we do? Those of you who want, you can write it down. How we are calculating market value? 3000 into 120. That is 3,60,000. This is the market value for the first issue. 2000 into 90. That is 1,80,000 is the market value for the second issue. 2,500 into 108. 2,70,000 is the market value for preference shares. Okay. 6,000 into 25. 1,50,000 is the market value for the equity shares. So for retained earnings, market value will be the same as this 1,50,000. Okay. So for this, it is 15 lakhs. Sorry, correct. 15 lakhs. Yes. Oh. So now let us, do the total also. We will write it down here. 3,60,000, 1,80,000, 2,70,000, 15 lakhs, and 1,50,000. Quickly do the total, everyone. We have just taken this here and substituted here. That's all. 24,60,000. Yes, dears. So now let us calculate the proportion. 3,60,000 divided by 24,60,000. That is going to be 0.146. So specific cost will not change. Okay. So 1,80,000 divided by 24,60,000. That will be 0.073. 0.109. 0.609. 0.0609. Okay. Now you should get a total of 1. Yes. Okay. So now we will calculate the WACC, which is cost multiplied by the proportion. 0.0127, right? 0.091 into 0.073, 0.0066. Okay. Then next one is 0.115. Okay. 0.115. Okay. Next is 0.0732. Okay. Next is 0.0069. All right. So what is the total coming up to? All of you please check. 11.09 percentage. So that is the value. Okay. So this also we have done. So now further, the company also intends to know the market price of the equity shares at the end of the current year, assuming approach is applied. Okay. That means what? Market price of the equity share at the end of current year means P0 or P1. They are asking for what is P1. Okay, equity shares. Okay, what is the P1 using approach? Okay. Approach, of course, we have done in dividend chapter. Just recalling this for you. Approach nally P0 is equal to D1 plus P1 divided by 1 plus KE. KE is cost of equity. D1 is what? D1 is dividend at the end of year 1. P1 is price at the end of year 1. P0 is the price right now. Okay. What is the right now price of the share? 25. Right now it is sold in the market for 25. So I will come and substitute here. T0 is equal to 25. D1. What is the dividend paid at the end of year 1? Can you all see this? It is 3 at the end of current year. Okay. So D1 is 3. Okay. Plus P1, that only we are asked to find out price at the end of year 1 divided by 1 plus KE. What is the KE, students? Let us go and see it here. KE is equal to 12 percentage. It's 0.12. Okay. So 25 is equal to 3 plus P1 divided by 1.12. Now we will do cross multiplication, which means we will get what? Right. Those of you writing, please write. It is going to be 25 into 1.12 is equal to 3 plus P1. So 25 into 1.12 is going to be 28. 28 minus 3 is 25 is P. 28 is equal to 3 plus P1. P1 is equal to 25. That is the answer. Ma'am, P0 is also 25. P1 also 25. No problem. That is what it is. So we have done the next part also. Assumptions, what and all we can say in assumptions, they have not taken issue cost into consideration. They have not given any value about payout ratio. Dividend payout ratio has been ignored. Okay. So tax, they have not considered. Risk uncertainty and all, they have not considered. So these are the disadvantages or assumptions of approach. There is no tax in this formula. Can you see? This is formula. There is no tax. There is no payout ratio. There is no ratio. Ratio is not there. And then what else can you say? There is no risk assessment. Okay. So these are the assumptions that we are making. Okay. So now we will go to the last part of this question. So sales is 20, variable cost is this, fixed cost is this, calculate all the leverages. Okay, leverage means what? The meaning of dictionary meaning of leverage is nothing but advantage. How advantageous are we? Okay, it is actually a measure of risk in financial management. It is a measure of risk. Higher the leverage, higher the risk. Okay, operating leverage is equal to contribution divided by EBIT. Financial leverage is equal to EBIT divided by EBT. And combined leverage is equal to operating leverage into financial leverage. Okay. The other formulas also we have discussed here. This much is enough for us. So now sales is given to be 20 lakhs. Variable cost is 12 lakhs. All given in the last point. That means contribution is going to be what? 8 lakhs. Minus fixed cost is going to be what? Given to be 5 lakhs. So that means EBIT is going to be 3 lakhs. Now comes the interesting point, interest. How to calculate interest? All of you, please listen here very carefully. We have interest on first issue as well as on second issue. We have interest on first issue as well as on second issue. Interest is always applied on face value. Very good, dear. Yes. So interest is applied on face value. Interest on face value only it will be calculated. Correct. So 3 lakhs into 12 percentage, that is going to be 36,000 interest for the first debenture. Interest for the second issue will be 12 lakhs into 13%, that is 26,000. So these are the two interests. Quickly write. Okay. First one is 12%, second one is 13 percentage. Okay. So 36 plus 26,000, that is the interest. 36,000 plus 26,000. 62,000, right. Then we will get what is called as EBT. That is going to be 2,38,000, right. So for us, it is enough up to this. If you want, you can, calculate even up to EAT. You have to subtract tax at the rate of 30% given in the question. Then you can find out EAT also. Okay. So now contribution is what? 8 lakhs. Divided by EBIT is equal to how much, mark? 3 lakhs. EBIT is equal to how much? 3 lakhs. Divided by EBT is 2,38,000. So operating leverage, financial leverage. 8 divided by 3. Yes, dear. 2.67 times. Please write that. 2.67 times is the operating leverage. Is the operating leverage. 1.26 times is the financial leverage. So 2.67 into 1.26. 3.36 times. This is the combined leverage. That is also over. So we have completed a 20-mark past exam question now. Okay. I hope you were all very comfortable with that. So now we will proceed to have some water. Oh, so now let us start with this problem. Following the extracts from the financial statements, that is Zipway Limited, earnings before tax, from that up to net profit they have given, and then that is net profit after tax. Okay. So then they have given equity share capital, reserves and surplus, non-convertible debentures. The market price of equity shares is 15. Okay. And the debentures market price is 95. Calculate EPS, percentage of cost of capital to the company for the debenture fund and equity. Okay. So now we will proceed to how to calculate EPS. EPS, as we all know, it is equal to earnings available for equity shareholders divided by number of equity shares. In corporate accounting, of course, you would have learned it as weighted average number of equity shares. Here it is just number of equity shares. So how to find out earnings available for equity shareholders? Very simple, EBIT. So I will write the entire format, which will be useful even for tomorrow's class. Sales minus variable cost will give us contribution, minus fixed cost will give me EBIT. EBIT minus interest will give me EBT. EBT minus tax will give me EAT. EAT minus preference dividend will give me earnings available for equity shareholders minus equity dividend will give me retained earnings. This is the chart, right? It makes sense. All of us know this. So I'm just going to continue. Okay. This earnings available for equity shareholders only they are talking about. Okay. So now in the question, what have they given? It's an easy question. You all can refer to the question. So I'm not showing it. So here we already have EAT that is given in the question, that is 120 lakhs. Okay. 120 lakhs. Preference dividend, they have given 10% non-convertible debentures is 500 lakhs. All right, students. So that means now what is the, have they given non-convertible debentures? They have not given preference shares. Okay. They have not given preference shares. Okay. So this is zero. So this is going to be 120 lakhs. Okay. There is no preference shares. There is only convertible debentures. So interest is already taken into consideration. So 120 lakhs. Okay. Number of equity shares. How to calculate number? So earnings available for equity shareholders is going to be 120 minus 0. That is 120. 120 lakhs divided by number of equity shares is how much? You all can see they have said that equity share capital is 500 lakhs. Equity share capital is 500 lakhs, which means number of equity shares will be divided by 10. So 500 lakhs divided by 10. Yes. So that is going to be 120 divided by 50 rupees 2.4 per share. We should write it this way, rupees 2.4 per share. That is the EPS. So the first part is over. Now, percentage of cost of capital to the company for the debentures fund and equity. Okay. So let us find out KD and KE. Okay. KD, we know that here market price is given. Okay. And there is no cost of issue. So which means we can take market price. Okay. And the life of the debentures is not given. So we will take it as irredeemable. Correct. So it will be interest after tax divided by MPS. That will be the formula. Correct? Irredeemable. Irredeemable. Okay. Interest is going to be, it is given 10% non-convertible debentures in the last line of the table. So it is going to be 10 percentage into tax rate is given to be income tax 40% they have given inside the table, which means after tax rate will be 60%. Tax rate is 40 means after tax will be 60. MPS. MPS is given in the last line of the question below the table. That is going to be 95. So now we will write down 6 divided by 95. How much is that? 6.31 percentage. 6.31 percentage. That is the cost of debt. Now let us find out the cost of equity. Cost of equity. What and all have been given? They have given DPS and they have also given what? Seeing a different question. Sorry. Yes, they have not given DPS, but just now we calculated EPS. So KE is equal to either DPS divided by MPS or EPS divided by MPS, or we know it is DPS divided by MPS plus G. So here this information is not there. So I will choose this. So what is the EPS here? Just now we found out no, on top. Can you all see this? This is 2.4. So 2.4 divided by MPS. What is MPS sub? Market price of the share that is given in the last line of the question. 15. 15. So divided by 15. So 2.4 divided by 15. How much is that? 16 percentage. 16 percentage is cost of equity. This also we have done. These are all capable of being asked for 5 weeks. 5 weeks. Past exam question only. Long back they have asked this question. Okay. So this problem is also over. Okay. The capital structure of Supreme Limited is given to me. First issue, second issue. Then we have preference shares, equity shares, retained earnings. Then we have EPS has 15. Okay. Shares of the company are sold and marketed book value. That means MPS is equal to book value as far as equity is concerned. And then we have company's tax rate is 30%. Shareholders' personal tax liability is 10 percentage. Okay. Calculate the weighted average cost of capital. Okay. So now they have not said what is the market price. Okay. Except that they have said that market price is the same as book value. Okay. So we will calculate WACC as per book value. But can you see first issue, second issue, preference shares, equity, then we have retained earnings. It is very similar to the Magma company that we did. This is also past exam. After about 10 years, that Magma company has been asked again. So similar questions may be repeated. That is why I've chosen these type of questions, which were asked a very long back. Okay. Let's see. Okay. Yes. So now we will proceed with the first. WACC means what? Weighted average cost of capital. First, we should take specific cost into proportion. We will take weighted average cost of capital. Okay. So now how to do? Okay. They have given EPS for everything else. They have given 6%, 7%, 8%. And they have not given anything else regarding issue cost and all that. So we will take that directly. Tax rate is given 30%. So we will use that for KD, cost of debt. Very good. So because KD is an allowable expense, we used to take interest after tax. We never took EPS after tax. We will never take the what to say preference dividend after tax because they are not allowable. Dividend is not allowable. But interest alone we used to take after tax. That is what we are going to do here. Okay. So now it is going to be KD. First issue is going to be what? Yes. First issue. KD is going to be 6 percentage. Yes. 6 into 70 percentage after tax, interest after tax. That is 4.2%. Second issue KD, it is given in the question that it is 7 percentage. So 7 percentage into 70 percentage, that is 4.9 percentage. Okay. Then next one is preference shares. Preference shares has anything been given in the question? Nothing, ma'am. So 8 percentage directly we will take. Whatever is given in the question, can you all see this? Directly we have taken. These two after tax I have taken. That's all, as I told you. EPS. Now they have given EPS in the first line of the paragraph, that is 15. Okay. And MPS is the same as book value, 100. Okay. So KE, this is the KPS. This is KD2. This is KD1. Okay. Cost of debt 1, cost of debt 2, cost of preference shares, cost of equity. Cost of equity is going to be what? Can I say it is EPS divided by MPS? EPS is given in the question to be 15, MPS the same as book value, so it is going to be 15 percentage. Okay. So then what we will do is, one minute. Now, KRE, they have said about shareholders' personal tax liability. I hope everybody is able to see. So shareholders' personal tax liability is 10 percentage. So let us take that. So we all know KRE is equal to what term? DPS or EPS after brokerage and after shareholder tax divided by MPS after capital gain tax. So here, how much is the EPS? 15. There is no brokerage. Shareholder tax is 10%. That means after tax will be 90% divided by MPS, that is 100. Okay. So now there is no capital gain tax, so I have not considered that. So 15 into 90%, that is 13.5. Yes. So everything is done. Please write it down quickly, then we will proceed. I have one small explanation to give here. That also I will tell. So shall we proceed? Yes. What is the small explanation? Please listen everyone very carefully. It is going to be, now equity shares is given in the question. Equity shares is given in the question to be 4 lakhs and retained earnings is given to be 1 lakh. 4 lakhs, retained earnings is equal to 1 lakh. Okay. So now, can I say the book value of equity is equal to 4 lakh plus 1 lakh, that is equal to 5 lakhs. Why? Because retained earnings also belong to the equity shareholders only. Profit retained inside the company is called as retained earnings. It belongs to whom? Equity shareholders. So it is going to be 5 lakhs. Okay. What are the number of shares given in the question? Number of equity shares given in the question. Let us see that. It is going to be 4,000. Okay. All right. Now. That means book value per share is equal to 5 lakhs, 5 lakhs divided by 4,000. Yes, 125 rupees, 125. This is equal to MPS. This is another way of calculating. This is also one way of calculating the market price per share. Okay. This is also one of the ways of calculating the market price per share. So in some problems in our textbook, they have done like this. So towards the end of cost of capital, if you all remember, correct. So now we can also do it that way. Otherwise, you can simply say the face value is given to be 100. So retained earnings we have considered separately. KE is equal to KRE. Here we have taken shareholders tax rate. Okay. So now we will proceed to what we have to do. KE is equal to EPS divided by MPS. We are recalculating. It is another way of doing. EPS is equal to 15 given in the question. MPS is 125. So 15 divided by 125. How much is that? 12 percentage. And same way, we have KRE, which is equal to EPS after shareholder tax. After shareholder tax divided by MPS. So EPS after shareholders tax is what? 15 into 90% divided by 125. 10.8. Okay. 10.8%. So we can do this way also. So based on if you're doing the other way around, you can say that you can do it this way by giving a foot. Okay. So now we will proceed with WACC. So we have particulars, that is capital structure. Then we will have book value, because there is no change in book value. I'm going to take book value, market value, everything is same. Based on that, we are taking proportion. And then we have next specific cost. And then we will have WACC. So the first one is going to be first issue of debentures. Second one is second issue of debentures. Third one is preference shares. Fourth one is equity shares. And fifth one is retained earnings. Okay. So now we'll just take it as it is. 2 lakhs, 1 lakh. I'm taking it from the question, right? Good. So it is going to be 2 lakhs, 4 lakhs, and 1 lakh. So the total will be 4 plus 4, 8 plus 2, 10 lakhs. So the percentage is also easy to calculate. 20%, 10%. So you want me to write in decimals? No, let me write in decimals. Right. So 0.20, 0.10, 0.20. I am very comfortable in percentage. That's one. 0.40, 0.10. Okay. Now specific cost. Specific cost we have already written here. 4.2, 4.9 and 8 percentage. 4.2, 4.9 and 8. 4.042, 0.049 and then 0.08, no? Which was, yes. So 0.08. 0.12. Remember everyone, I had given the footnote also. And 0.108. 0.108. So again, I'm saying how we recalculated, because the total book value of equity is 5 lakhs, 4 lakhs plus 1 lakh divided by total number of shares is 4,000. 5 lakh divided by 4,000, 125. That is how we got it. 0.2 into 0.042. Point 0.0084. Point 0.016. 0.4 into 0.12. 0.048. 0.0108. 0.0881 or 8.81 percentage. This is the value. Okay. So this also we have done. This is also a very good question from exam point of view for 5 marks. Okay. Shares of Alpha company are currently being quoted at a price earnings ratio, that is P ratio is equal to 7.5 times. Okay. And retained earnings of the company is at 37.5 percentage. Okay. You are required to compute the company's cost of equity if investors expect an annual growth of 8 percentage. Okay. Anticipated growth rate is 10 percentage. Compute the indicated market price with the same cost of capital. If the cost of capital is 15 percentage and anticipated growth rate is 11 percentage per annum, compute the market price per share, assuming other conditions remaining the same. Okay. Now, how are we supposed to do this? Now, what and all are given to us? P ratio is equal to 7.5 times. Some students are telling me, ma'am, I don't know how to remember this. Extremely simple, no? P means price, E means earnings. So price to earnings ratio. Pre means MPS, market price. E means what? Earnings, EPS. MPS divided by EPS is what is 7.5 times. Easy, no? Yes, no. P stands for price. E stands for earnings. Market price, earnings per share. Okay. So now having said this, now we have here, can I say total earnings is equal to, yes. So total earnings is equal to 6 divided by 37.5 percentage. That is going to be what? Yes, ma, 16 rupees, 16. Okay. So now the first one, they have said compute the KE if the annual growth rate is 8 percentage. Okay. So for that, we need what? P0. Okay. P0 is what? Market price. Okay. So can I say P ratio is given to us? That is going to be what? P ratio is MPS divided by EPS is equal to 7.5 times. Okay. MPS, I will keep it as it is. EPS is what? 16 is equal to 7.5 times. Okay. So just now we calculated 16. Okay. So MPS is equal to 16 into 7.5 times cross multiplication. So it is going to be 16 into 7.5. That is going to be, yes, 120. So again, I'm repeating. P ratio is given, that is 7.5. Total earnings we found out, that is 16. So we substituted the EPS here, 16. That is how we got MPS. Okay. So why did we find out MPS? Because that is what they have asked in the question. Cost of equity. Whenever growth rate is given, cost of equity, we know we have three formulas. What are the three formulas? DPS divided by MPS, or EPS divided by MPS, or we should use what? DPS divided by MPS plus G. In other words, this can be written as D1 divided by P0 plus G. Isn't it, everyone? So this is how we should proceed. So we will use this formula. That is what is now applicable for us. So D1 divided by P0 plus G. Okay. So they have said what? Compute the cost of equity. Okay. So now for that we need D0 also. So let us find out D0. dividend is equal to MPS into, so, very sorry, EPS into EPS. So I'll explain it to you this way. EPS, earnings per share, earnings, either you can pay as dividend or you can retain. They are retaining how much? 37.5%. That means they will pay how much? 62.5 percentage. Correct. So this is given. This is a balancing figure. So 37.5 is retained, means 62.5 is paid as dividend. Okay. So the EPS is how much? Just now we calculated is 16. Okay. 16 into 62.5. 16 into 62.5 percentage. How much is that? That is 10. Okay. So the dividend is 10. And the growth rate is given to be 8 percentage. Growth rate is given to be 8 percentage. D0 is 10. Right now, EPS is 16. So right now, dividend is 10. But what I need for formula, D1 divided by P0. I already told you D1 means dividend at the end of year 1. Right now, dividend is 10. So at the end of first year, it will be 10 into what percentage? It is growing at 8 percentage. So it is going to be 10 into 108%, that is rupees 10.8. So quickly I will explain once again, listen. 16 rupees is the earnings. Out of that, sometimes full money also they can give you. Full dividend can be paid, but they are not doing it. 37.5 is retained by the company for every share, and 62.5% is paid as dividend. Okay, 16 into 62.5, it comes to 10 rupees. So for every 16 rupees, 10 rupees is paid as dividend, 6 rupees is kept as retained earnings. But this is the current scenario right now. The formula for KE is what? D1 divided by P0 plus G. D1 is what? D0 is 10. It will grow at 8 percentage. So 10 into 108 percentage is, yes, ma, 10.8. That is what is D1, dividend at the end of year 1. Okay. So it is going to be 10.8 divided by P0. What is the P0, students? Already we calculated MPS is 120. Growth rate is going to be 8%. Again, I'm repeating. In tomorrow's class, again, I will tell. But please listen very carefully. Growth rate can be substituted only when it is stable. Okay, only when it is stable. If the growth rate is 8% now, next year it is 7%, next year it is 6%, or next year it is 12%, like that, if it keeps changing, I can't use this formula. For me to use this formula, growth rate should be stable. Okay, yes. So now, how much are we getting, dears? Please do the calculation and tell me. 17 percentage. Okay. Everybody please check 17 percentage. The second thing that they are asking in the question is, if the anticipated growth rate is 10%, compute the indicated market price with the same cost of capital. Okay. So now, can I say D1 is going to be 10 into 110 percentage. So the growth rate is different. It is not changing. Okay. It is a different scenario. It is a different scenario. Okay. It is going to be 11. Okay. Next up, we can say P0 is equal to D1 divided by KE minus G. No, that also we all know. Okay. All right. Nothing much. Same formula. So if you're getting confused, no problem. I will write it once again for you. Don't write. KE is equal to D1 divided by P0 plus G. Right? So can I say, I'll bring G to the other side. KE minus G is equal to D1 divided by P0. Now I will cross multiply. By cross multiplying, I'll have P0 here, D1 divided by KE minus G in this side. Okay. So like this also you can remember, you don't have to by heart. You know this formula. That is how this formula came. Okay. So now P0 is equal to D1, that is 11. Just now I told you it is 11, alva, here. So 11 divided by KE. How much is the KE, students? Just now we found out it was 17 percentage. They have said cost of capital is not changing in the second subdivision. So it is going to be 0.17 minus 0.10, because in the second scenario, G is 10. Okay. So 0.7 minus zero point 0, that is 0.07. 11 divided by 0.07 is going to be, yes, 157.14. 157.14 is the price of the share in the second scenario. All these are important questions because it is a part of cost of capital also, it is a part of dividend also. Okay. Now, the company's cost of capital is 15%. Anticipated growth rate is 11%. Compute the market price. Okay. So again, we have KE is equal to D1 divided by P0 plus G. Okay. D0 is equal to 10. G is equal to what? 11%. That means, can I say D1 is equal to 10 into 11%? That is going to be, yes, 11. Right? Okay. I'll write like this. 1. 10 into 111 percentage. Ma'am, why? 100% plus 11%. So 111 percentage. So it is going to be, or you can do it this way, 10 into 100% plus 10 into 11%. Like that also you can do. So it's okay, however you want to do. So this is nothing but 11.1. Okay. So now we will proceed. They have given in the question, that is the third subdivision, that KE is equal to 15%. Okay. So now we will substitute here. So we know D1 in this formula. Can I say KE minus G, when G goes to the other side, it is equal to D1 divided by P0. Now I'm going to use this formula below. So KE minus G, just now I wrote on top, is equal to D1 divided by P0. Now cross multiplication. From here, we did this. Now we are doing this. Okay. So P0 is equal to D1 divided by KE minus G. Okay. So now D1 is what, students? 1. T0 is equal to D1 is 11.1. Just now we did on top 11.1. KE is 15%. 0.15. Excuse me. For the third subdivision, growth rate is 0.11. 277.5. Okay. Rupees 277.5 is the price of the share. So all the possible, places of testing we have written. I have not made a checklist for cost of capital because we have just done all these problems. Okay, just like that, we have done all the problems. So question number 10 will be a homework. So we have done extensively capital budgeting and capital structure, past exam questions, a lot of things we have done today. I'm really happy with the revision. I hope so you are. Yes, amazing. Good, good, good. So amazing. Right. So let us enjoy effort for one more day tomorrow. Okay. So tomorrow, power packed revision, it will be from the rest of the topics, all important concepts and questions from past exam. So see you at 10:30 tomorrow. Bye, everyone.